Hello, my name is Oktay Urcan. I am an Associate Professor of Accounting here at University of Illinois. I teach financial accounting related classes at the undergraduate, MBA, Executive MBA and PhD levels. I have been associated with the University of Illinois for about 2 years. Before that, I was an Assistant Professor of Accounting at London Business School in the United Kingdom. I conduct research in the archival capital markets area. My recent research interests are in the growing interdisciplinary research area called macroaccounting, which studies the interaction between macroeconomy and accounting. My research investigates how aggregated accounting numbers help predict important macroeconomic variables, including GDP growth, employment growth, and inflation. I will be teaching financial accounting course in our IMBA program. Accounting is the language of business. Decision makers both within and outside of firms in business life need relevant and reliable information to make decisions. In this class, you will develop a deep understanding of particular type of information provided by each financial statement and how decision makers can benefit from financial statements. Accounting knowledge also serves as a foundation for other classes you will take in IMBA program. These classes include finance and strategy. Welcome to financial accounting. Let's begin.
Too often, smart, hardworking, busy people miss out on education because of traditional linear learning. So learn on your terms. With stackable online content from Geese College of Business, you can take self-paced classes, earn transcriptable credit, pause, earn a degree, switch and stack coursework, earn a certificate, or learn however you want. You'll get expert-led education in big or bite-sized increments. Wherever you are in your learning journey, the right time to start at Geese is your time.
Hello, welcome to first class of financial accounting here at University of Illinois. Today we are going to talk about long-term assets. In particular, we are going to discuss accounting for long-term assets, accounting for depreciation, and accounting for asset disposals as well as asset impairments. But before we start, let me briefly remind you asset recognition criteria, which is going to be quite important for this lesson. In accounting, not every expenditure is an asset. In other words, in accounting, we do not capitalize every expenditure as an asset on the balance sheet. For an expenditure to be an asset, it has to satisfy two criteria. First, the benefit coming out of this asset needs to be quantifiable. And second, rights to use these assets should be obtained because of some past transactions. Most of the time in practice, the most important criterion is the number one, whether the benefit coming out of this asset is quantifiable or not. Let me make a small note here. We have two groups of assets, tangible and intangible. Tangible assets are those where we can really touch them. Intangible assets are the ones that we cannot touch them, but we can still see them on the balance sheet. I'm going to give an example. Buildings. Is buildings an asset? Yes. Why? First of all, is the benefit quantifiable? Yes. The money that you spend to build the buildings or to buy the buildings are quantity or the value of that building. And the rights to use the buildings are coming out of some past transactions? Yes. I mean, in the past, we acquired these buildings through a contract, and therefore we have the right to use these buildings. And at the same time, by the way, buildings are some tangible assets. You cannot touch them. Same thing is also true for land. But how about R&D expenditures, research and development expenditures? Research and development expenditures in accounting are not an asset. Why? Because it doesn't satisfy the first asset recognition criterion, which is the benefit should be quantifiable. Research and development expenditure is certainly very important, but we cannot quantify this, the benefit coming out of research and development. Sometimes you spend lots of money on R&D, but you get nothing out of this, and therefore R&D expenditures are not an asset. Instead, as soon as we spend the money on R&D, we immediately expense them. And same thing is true also for advertising as well as training. For example, advertising is very important, but the benefit coming out of advertising is not quantifiable. Therefore, advertising expenditures are not an asset, they are just normal expenditures. A very interesting asset here, which is patents acquired. Patents are, first of all, intangible assets. We cannot touch them. But when they are purchased from somebody else, we can create an asset for these patents. Why? Because the benefit is quantifiable. We have a value associated with these patents. Now is a good time to start our topic of today, which is fixed assets. So what do we mean? What do we know about fixed assets? Fixed assets are the ones which has a life more than 1 year. Buildings are fixed assets. Lands are fixed assets because they generally have a life more than 1 year. When we have fixed assets, the question now becomes, what is the value that I need to put associated with this fixed assets on the balance sheet? During the acquisition, the general principle is any money that you spend in the acquisition of the fixed asset as well as preparing to use this fixed asset can be capitalized on the balance sheet. For example, for a firm, if they buy a truck as a fixed asset, purchase costs, transportation of the truck to the facility, as well as, for example, insurance during the transportation can be capitalized. So one more time, any money that you spend until the fixed asset is ready to use can be capitalized on the balance sheet. There is a small note here. For assets that are constructed, any cost that we spend on constructing this asset can be capitalized. Any construction cost, this also includes interest. So these are costs that can be capitalized during the acquisition. Now my question is there any cost we can capitalize after the acquisition of the asset? And the answer is depends. If the expenditure increase useful life, decrease operating costs, or increase productivity, then we can capitalize these expenditures as a form of fixed assets. On the other hand, for example, if you spend money on maintenance of the fixed assets, it cannot be capitalized. It has to be immediately expensed. Okay, now we have a fixed asset on our balance sheet. It has a value associated with this. What's going to happen? First, we are going to use this fixed asset over its useful life. During this useful life usage, what we need to do is that we need to allocate some of the value of this asset to income statement as an expenditure. Since we are using this asset, there should be an expenditure associated with this usage. And this process is called depreciation for fixed assets, amortization for intangible assets, and depletion for natural resources. Very important note here, depreciation is nothing to do with current market value. Depreciation is to do with the fact that we have this asset, we use it, and therefore associate with this asset at the end of every year or every quarter, there should be some form of expenditure, depreciation expenditure on the income statement. My question right now is, how am I gonna estimate, how am I gonna calculate this depreciation expense? In order to calculate depreciation, you need to estimate three things. These are salvage value. Salvage value is the value of the asset after we consume all of its useful life. Let's say we have a truck, it has a useful life of 10 years. The question here is, after the 10 years of usage, what is the value of this truck? That is salvage value. Second, you need to estimate useful life. And third of all, you need to come up with a depreciation method. There are many depreciation methods that you can choose. The most common one is a straight line one, over which we estimate depreciation, and then the depreciation expense is the same every year over the useful life of the asset. And there is another popular one, which is accelerated depreciation. Under accelerated depreciation, we initially have a lot of depreciation expense, and gradually the amount of depreciation expense goes down. As I said, the most common one is a straight line, and for that purpose, I'm going to do an exercise about straight line depreciation. Under straight line depreciation, depreciation expense is calculated as annually purchase cost minus salvage value divided by useful life. And here is an example. Elina Supermarket purchases a new truck by paying $35,000. This truck has a useful life of 10 years. It has a salvage value of $2,000. My question here is, what is the accounting for depreciation of this asset? But first of all, here are my accounts that I'm going to use to record this transaction. I have cash. Second of all, I have PPE, which stands for plant, property, and equipment. Any fixed asset that I acquire should be classified under this account, plant, property, and equipment. Third of all, I have accumulated depreciation. Accumulated depreciation is the account that I'm going to book the depreciation expense of plant, property, and equipment. And then I have under shareholders' equity IS, which is income statement. And I also have retained earnings, RE. First of all, we need to acquire this asset and we need to record acquisition of this asset. What's going to happen? We pay cash, therefore there will be a cash decline of $35,000, and we create a new asset, truck, on our PP account, which is $35,000. and then we use this asset for a year. My question here is this: what is the amount of depreciation and how am I going to record this? Well, first of all, we need to calculate the amount of depreciation expense. If you look at the IS column, what is the amount of depreciation expense? Well, we just follow the formula we have just talked about. It is original purchase cost, $35,000, minus $2,000 of salvage value, divided by 10, which is going to give you annual depreciation associated with this truck of $3,300. Notice that it is a depreciation expense. It is in parentheses under income statement. Question now is, what is the second leg of this transaction? Well, since we are using this asset, there should be a decline in the value of the asset on the asset side. And this is where accumulated depreciation comes into picture. I'm not directly reducing PP&E account for this depreciation. Instead, I am creating this accumulated depreciation account, which is a contra asset. It's an asset, but it has a value of negative. And as you see here, I record the other side of this depreciation as $3,300 reduction from accumulated depreciation. So the message here is that accumulated depreciation is used to record the depreciation of PP&E account. It has a balance of negative almost all the time. The maximum that you have on the accumulated depreciation account could be 0. It is never positive. Now we are going to talk about disposal of fixed assets. When we acquire fixed asset, it doesn't necessarily mean that we use these assets until the end of their useful life. There are a lot of cases where fixed assets are sold before their useful life. And in this scenario, you need to calculate two things for accounting purposes. The first one is net book value, NBV. Net book value is equal to original cost of this fixed asset minus all accumulated depreciation of this fixed asset. And the second thing that you need to calculate when you dispose of an asset is gain or loss coming out of this disposal. It is calculated as sales price minus net book value that you have just calculated. Let me give you an example. Again, my classic example, Elina Supermarket acquires a truck by paying $35,000. It has an estimated life of 10 years, salvage value of $2,000. Well, what happens is that after the 5 years of usage, Elina Supermarket sells this asset for $20,000. So the question here is, how are we going to do the accounting for this? But first of all, you need to do accounting for the 5 years of usage of this fixed asset. So what's going to happen is that when you acquire this asset, obviously there is a cash decrease of $35,000. There is a PPE, asset creation of $35,000. And then you need to record 5 years of usage of this asset under accumulated depreciation. As we have calculated in the previous video, annually the amount of depreciation is $3,300 times 5 will give you $16,500 under accumulated depreciation. And notice that same number also shows up under retained earnings. Why? Well, normally accumulated depreciation will show up under income statement, but we know that the balances at the end of every year under income statement is transferred to retained earnings. That's why $16,500 also shows up under retained earnings. Now at this point we are going to sell this asset for $20,000 cash. Let's sell it. First of all, there is a cash increase of $20,000. Second of all, since we sold this asset, you need to close PP&E account as well as accumulated depreciation associated with this asset. Therefore, notice that PP&E account is closed by putting a negative $35,000. Notice also that accumulated depreciation also closed by adding a positive $16,500. So now we are ready, and we said whenever we dispose of an asset, we need to calculate two things. The first one was net book value, which is equal to original cost of this asset. In our case, it is $35,000 minus accumulated depreciation of this asset, which is $16,500. If you calculate this, you're going to come up with $18,500, which is the net book value at the time of sale of this asset. And the second that you need to calculate when you dispose of an asset was gain or loss, which is equal to the sale price. In our case, it is $20,000 minus net book value of this asset, which is $18,500. It's going to give you a gain of $1,500, and that is going to be recorded under income statement. Now, I'm going to tell you about gross versus net plant property and equipment. That's going to be quite important, especially when we are presenting these assets on our balance sheet. First of all, gross PP&E. Here we have total purchase cost of all fixed assets. It has nothing to do with depreciation. Whenever you spend money on acquisition of new assets, that's going to show up under gross plant property and equipment. Second of all, we have accumulated depreciation, which is the account where we record all depreciation expense of all PP&E. And finally, the difference between gross PP&E, which is the original purchase cost, minus accumulated depreciation will give you net plant property and equipment. Why am I emphasizing this? I am emphasizing this because if you look at, which we are going to also look, real financial statements, there are a lot of cases where you don't have idea about gross original purchase cost of fixed assets or accumulated depreciation. Most of the time, if you look at real balance sheets, what you see is the net plant property and equipment, which is the difference between original purchase cost, gross, minus accumulated depreciation. Since these accounts are quite important, what I'm going to do is I'm going to tell you now how these accounts change over a year. Let's start with the gross plant property and equipment. One more time, in this account, we record original purchase costs. How does this account change? Well, there is a beginning balance. Gross PP&E will go up whenever we acquire new assets. That's additions. Gross PP&E will go down whenever we sell these assets. There is an asset disposal. But what is the reduction from gross PP&E? It is the historical cost of this asset. It is undepreciated amount that's going to be reduced from gross PP&E. And finally, we are going to come up with ending amount of gross plant property and equipment. Second of all, how does accumulated depreciation change over time? Well, as always, there is a beginning amount of accumulated depreciation. Notice that accumulated depreciation is always a negative number. Accumulated depreciation will go up whenever you have new depreciation expense. By go up mean it's going to be much more negative. You're going to increase the size of accumulated depreciation. Accumulated depreciation will go down whenever you sell the assets. As we have done in the previous video, whenever you sell an asset, you need to close accumulated depreciation associated with that asset. And finally, we have ending amount of accumulated depreciation. And now I'm going to also go through how net plant property and equipment change over time. But let's remember one more time, net PP&E is equal to gross PP&E minus accumulated depreciation. Therefore, what I can do is that I can take the gross PP&E column, I can also take accumulated depreciation column, and I can do a reduction between these two columns. For example, gross opening balance of PP&E minus opening balance of accumulated depreciation will give you opening balance of net plant property and equipment. Additions, can I reduce this with something else? No. So therefore additions will show up under net PP&E column directly. How about sales? Well, this is the sales original cost of a sold asset minus, there is another sales under accumulated depreciation column. Basically, sales original cost of this PP&E minus accumulated depreciation of this PP&E will give you sales net book value. Remember net book value, which is purchase cost, which is gross PP&E minus accumulated depreciation. What else I have here? Well, I also have depreciation column under accumulated depreciation. What we were doing was gross PP&E minus accumulated depreciation. Therefore, the sign of the depreciation will be negative under net PP&E column. And finally, you have the ending balances of gross PP&E minus ending balance of accumulated depreciation will give you ending balance of net PP&E. I understand that this is a lot of things to go through. Therefore, let's do an exercise. Illini Supermarket has the following balances on its balance sheet and income statement. So what are these balances? For example, we have balance of gross PP&E at the end of year 2014 and at the end of year 2015. Similarly, we have accumulated depreciation for these 2 years. And we also have depreciation expense, which is given to us as $15,000 for year 2015. And we are also given a piece of information. Assume that Illini Supermarket purchases new fixed assets worth $35,000 in year 2015 and sells a truck for $25,000 in cash again in the same year. The question number one is, what is the original cost of the truck sold in year 2015? So basically we are talking about the truck sale in the last sentence here. We are selling a truck for $25,000 in year 2015. The question is asking you, what is the original money that we spent in the acquisition of this truck? Since we are talking about the historical cost, we are talking about original purchase price, you need to go through gross PP&E account. How does gross PP&E change? That is beginning balance plus new purchase of PP&E minus PP&E of the sold asset, which is what we are after, and you come up with the ending balances. Beginning amount of gross PP&E, according to the previous slide, is 40,000. Ending amount of PP&E is 65,000. I just put them in their place. And new purchase of PP&E, according to the previous slide, if you look at the sentence, Elina Supermarket purchases new fixed assets worth $35,000. It is also there. Minus PP&E sold, that is what we are after. So if you do this calculation, beginning plus new purchases minus closing balance, which for this is 40,000 minus 35,000 minus 60,000 will give you 10,000 as an original purchase cost of this truck. Here is my second question. What is the accumulated depreciation of the truck sold in year 2015? For this purpose, you need to go through how accumulated depreciation account change. Well, accumulated depreciation account change as follows. There is a beginning balance. Accumulated depreciation will go up when you have new depreciation expense. It will go down whenever you sell an asset. You need to reduce the accumulated depreciation of the sold asset, and by the way, this is what we are after. And finally, you have the ending balances of accumulated depreciation. According to our question, beginning balance of accumulated depreciation is 15,000. New depreciation expense for year 2015 is again another 15. And at the end of the year, we need to end up with closing balances of 25,000. If you do the calculation of 15 plus 15 minus 25, you are going to come up with 5,000 as the accumulated depreciation of the truck sold. Here is our third question. What is the gain or loss from the sale of this truck? And as we have mentioned previously, whenever you sell an asset, you need to calculate two things. First, net book value, which is the difference between original cost of this asset and accumulated depreciation. And second of all, you need to calculate gain or loss. Gain or loss is equal to sale price minus net book value of this asset. So according to the question, we are selling this truck in year 2015 for $25,000. That's the sales price. Next question is, what is the net book value? Net book value is the difference between original cost, and according to question number 1, original cost is $10,000 minus accumulated depreciation of this asset, which is $5,000 according to question number 2. So net book value of this asset is 10,000 minus 5,000, 5,000. Sales price is 25,000. Therefore, this asset sale results in a gain of $20,000. Now I'm going to talk to you about asset impairments. Under asset impairments, what happens is that for some reason, the value of this asset that will show up on the balance sheet decreases unexpectedly. Under accounting, we are very conservative. Therefore, whenever assets are impaired, we need to do accounting for these impairments. What is the asset impairment accounting? Well, first of all, you get rid of accumulated depreciation associated with the impaired asset. Second, you need to reduce value of the asset to the impaired amount. Third of all, you need to recognize a loss associated with this asset impairment. And one important thing here is that this is permanent. In the future, let's say the value of the asset goes up for some reason, you just cannot go back and undo your asset impairment. Asset impairments are permanent. Let's do an example. Elina Supermarket again buys this truck for $35,000. It has a life of 10 years and it has a salvage value of $2,000. The value of the truck after 2 years of usage becomes $20,000 for some reason. And the truck is depreciated using straight line method. How are we going to do this with asset impairment? But first of all, we need to do the accounting for purchasing this asset as well as using this asset just before asset impairment. So it's 2 years of depreciation recording is necessary. So cash goes down by $35,000. There is a PP&E of $35,000. As we have calculated in the previous videos, annually, the amount of depreciation is $3,300. 2 years of depreciation will give you $6,600, and the same number will also show up under retained earnings. We know that at this stage, the value of this asset becomes somehow $20,000. So asset is impaired. How are we going to do the asset impairment accounting? First, you get rid of accumulated depreciation. As you see, I am adding 6,600 to accumulated depreciation account so that accumulated depreciation becomes 0. Second, you need to reduce the value of this asset to $20,000. On the asset side, I have 35,000. I deduct 15,000 so that the new value becomes $20,000. And finally, you create a loss. What is the size of this loss? It is equal to reduction from PP&E, 15,000, minus reduction from accumulated depreciation, 6,600, which is going to give you 8,400 as a loss, impairment loss on your income statement. And then we come to the end of the year and we close the accounts. Notice that cash is minus $35,000. Notice that the value of the asset now becomes $20,000. It looks like a new asset is born. Notice also that there is no more accumulated depreciation for this account. And finally, we transfer the balance from income statement to retained earnings. Now our question is how assets are presented in real financial statements. Here is assets of Walmart in year 2015. And let's look at the assets of Walmart. So here we have property and equipment value of $177,395. We also have accumulated depreciation. Notice that it is a negative number. How much? $63,115. And Walmart also provides us net property and equipment of $114,280. Is it a big number? It's a very big number. If you look at the total assets of Walmart, it is a little bit over $200,000. And what we have here is that almost more than half of these assets are coming from net property and equipment. That's a huge number. My question right now is, yes, we have a property and equipment account, but it really doesn't tell me what kind of assets Walmart has. Where will I get this information? If you need some more clarity about where these assets are coming from, you need to look at notes. And here is the note 1 of Walmart, and under note 1, there is a lot of clarity about where this property and equipment is coming from. If you look here, under the asset side of Walmart, we have land. We have a lot of buildings. These are super stores of Walmart. We have fixtures and equipment within the buildings. We have transportation equipment. And we also have construction in progress. As we have mentioned at the beginning of this module, construction progress is capitalized. Any money that you spend in the construction can be capitalized. We also have accumulated depreciation account, and we come up with the ending net property and equipment of $114,280. My next question is, what is the amount of depreciation expense for year, for example, 2015? All I have here is the accumulated total amount of depreciation. If you want the depreciation expense for 2015, you need to look at income statement. And here is the income statement of Walmart. I'm searching for depreciation expense. You can search, but you are not going to find it. Because what happened is that Walmart writes this depreciation expense under a special account called operating, selling, general, and administrative expenses. So a lot of expenditures are bundled together under this account. Its size is $93,418. It really doesn't tell much about depreciation to me. If I really want to learn depreciation, then what do I need to do? You need to go to the notes of Walmart. According to note 1, depreciation expense for property and equipment for fiscal year 2015, 2014, and 2013 was $9.1 billion, $8.8 billion, and $8.4 billion respectively. The point I'm trying to make here is that for some of the numbers, you cannot see on the financial statements directly. If you want these details, you need to definitely know how to look at the notes. You need to go through the details. This concludes our module 1. In this module, we went through accounting for long-term assets. We went through accounting for depreciation. We also do some exercises about accounting for asset impairments as well as asset disposals. In the next class, we are going to talk about accounting for liabilities. Until that time, take care. Now, we are going to discuss some cases to see what we have learned can be applied in real life. Before we go further for these cases, I strongly recommend you download the cases, work on them by yourself, and then come back to watch the videos to get the maximum benefit out of these cases. Here is case number 1. Use the financial statement excerpts for United Health Group and the information below. Answer the following questions. 1. How much did United Health Group originally pay for all the property and equipment it owned at December 31st, 2016? And the question is explicitly telling you that exclude capitalized software. The answer is 6,492 million. How do we get this? You look at footnote number 5. This is about property, equipment, and capitalized software. And you sum the first items here. Please note that these 4 items do not include accumulated depreciation. Why? Because the question is asking us what is the original amount of payment. If you sum the first 4 items here, you're going to find that United Health Group originally paid for all of this property and equipment 6,492 million. Question number 2. Assume that United Health Group purchased property and equipment costing 1,525 million during 2016. Also assume that United Health Group sold one piece of equipment for 455 million in cash, and then there were no impairments. The first part of this question is, how much did United Health Group originally pay for the property and equipment that was sold? To answer this question, you need to go to how gross PP&E account changes. For this purpose, let's just look at the formula here. Ending balance of gross PP&E is equal to beginning balance of gross PP&E plus purchases of PP&E minus original cost of PP&E sold. Ending and beginning balance of PP&E is coming from, again, note number 5. For beginning, we sum the numbers, these first 4 items in year 2015, and for ending balances, we sum the numbers in year 2016. And then we are given the amount of purchases for the PP&E in this year, which is 1,525. And if you do the algebra, you're going to find that original cost of the PP&E sold is 425 million. B of the same question, at the time of sale, what was the accumulated depreciation on the property and equipment that was sold? To answer this question, we need to go through how accumulated depreciation account changes. Ending balance of accumulated depreciation is equal to beginning balance of accumulated depreciation plus depreciation expense minus accumulated depreciation of the PP&E sold, which is what we are after. So ending balance of accumulated depreciation is 2,621. Beginning balance of accumulated depreciation is 2,163. So where are these numbers coming from? They are again coming from note 5. There is an item called accumulated depreciation. I'm using the numbers 2015 and 16 for the beginning and ending numbers. And then at the end of this note number 5, we also have a paragraph which is telling us how much is the depreciation expense over the last 3 years. If you read it here, you are going to see that the depreciation expense for this year is 698. And if you do the algebra, you are going to find that the amount of accumulated depreciation for the PP&E sold is 240 million. Here are our second case. This is about Kroger Company, and let's just read this question. Please consider the balance sheet, cash flow statement, and notes to the consolidated financial statements for Kroger Company below and answer the following questions. But before we go further, we need to make some assumptions. 1, there were no impairments of property and equipment during fiscal year 2016, which ended January 28, 2017. There were no additions or disposals of intangible assets, and some additions to property and plant and equipment were not paid in cash. Question number 1, what is the net book value of Kroger's property, plant and equipment for 2017? The net book value means whatever the net number that you see on the balance sheet. Book value means the balance sheet number. So I'm going to look at the balance sheet. I'm going to see net. What is the amount of property, plant and equipment? If you do that, here is the balance sheet of Kroger for year 2016, which is ending in January 2017. The amount of net PP&E is 21,016. So let's just see this number one more time. For year 2016, which is ending in 2017, the amount of net PP&E is 21,016. Here is our second question. Kroger has disposed of some property, plant, and equipment during fiscal year 2016. The sale price of disposed items was fully collected by the end of the fiscal year, and Kroger recognized a loss of 13 million on the sale of these items. So accordingly, here's our first question. What was the accumulated depreciation and amortization associated with property and equipment disposed during fiscal year 2016? Just like the previous question, to answer this question, we need to go through how accumulated depreciation account changes. Ending amount of accumulated depreciation is equal to beginning amount of accumulated depreciation plus depreciation expense minus accumulated depreciation of sales. Beginning and ending balances of accumulated depreciation are 18,048 and 19,572 respectively. Where are these numbers coming from? They are coming from footnote number 4, property, plant, and equipment. There is an item called accumulated depreciation. This is where I get those numbers. We also need, to answer this question, we also need the depreciation expense number, which is 2,340. Where is this number coming from? It is coming from our consolidated statements of cash flows, which we are going to cover in module number 4. But for now, you need to know that when we are going through the cash flow statement, one of the adjustments that we do is for depreciation charges. So the depreciation amount is 2,340, and then if you do the algebra, you are going to find that the accumulated depreciation of the sold item or disposed item is 816 million. Part B of this question is, what was the original acquisition cost of the property, plant, and equipment disposed of during fiscal year 2016? In order to answer this question, we are going to do something different. We are not going to use gross PP&E, but instead we are going to do something different. So let's just remember a couple of formulas that we have used during this module. Net book value of the item sold is equal to proceeds that you raised selling the item plus the loss. Okay? So we sold this item for how much? 132. And the question is explicitly telling you that when we are selling this asset, we made a loss of 13. Therefore, net book value of this asset is how much? 145. So let's just see where 132 is coming from. It's coming from, again, cash flow statement. We have an item called proceeds from the sale of assets, and this is where 132 is coming from. So what's going on here? So we have an asset. Its book value is 145. We are selling this asset for 132. Therefore, it must be the case that we are making a loss of 13 million. And then I'm going to go one more step. So what does net book value of an asset mean? Well, net book value of an asset can be used in the second formula. Acquisition cost of an asset is equal to net book value plus accumulated depreciation, right? Or in other words, what is net book value? It is the difference between acquisition cost minus accumulated depreciation. So we have calculated accumulated depreciation in the previous question as 816. And then I can use these two numbers that I know of, net book value and accumulated depreciation. I can sum them up. I can find that original acquisition cost of this disposed item is how much? 961. C. How did the sale of property, plant, and equipment affect Kroger's cash flow from operations, and how did it affect Kroger's total cash flow? The sale had no effect on cash flow from operations. Asset purchases or sales are nothing to do with operations. It increased the cash flows from investing activities and hence the total cash flow by 132 million. If you look at here, the cash flow statement, look at the title, cash flow from investing activities. The item here is proceeds from sale of assets, which is 132. D. What was the value of property, plant, and equipment acquisitions that Kroger paid for in cash during fiscal year 2016? To answer this question, we are going to look at cash flow statements, the investing section, and we are going to find that that number is 3,699. Let's just see this item. This is investing activities. The first item here is the money that is spent on acquisition of some assets, and how much is that value? 3,699. Since the question is explicitly asking you how much we paid explicitly in cash, therefore we got to look at cash flow statement. And finally, what was the value of additions to property, plant, and equipment during fiscal year 2016? In order to answer this question, I'm going to go through how gross PP&E account changes. Ending amount of gross PP&E is equal to beginning amount of gross PP&E plus additions minus sales or acquisition cost of the sold or disposed items. So beginning and ending balance of gross PP&E is coming from, again, footnote number 4. We need additions. That's what the question is asking us. And finally, in a previous question, we calculated the original cost of the disposed item as 961. And if you do the algebra, you're going to find that the total additions to plant, property, and equipment in this fiscal year is 3,882 million. Here is the third case. Use the financial statement excerpts of PepsiCo and the information below. Answer the following questions. Question number 1. How much did PepsiCo originally pay for all the plant, property, and equipment that it owned at December 2017? The answer is 39,106. Where do I find this information? I am going to look at footnote number 4 for property, plant, and equipment. I just sum all these numbers without accumulated depreciation. Why? Because the question is expressed asking me how much we originally pay without depreciation. And that's going to be 39,000. Let's just see this footnote 4 one more time. It is going to be 39,106. We just sum all of these items without reducing accumulated depreciation. Question number 2. Assume that Pepsi purchased property and equipment costing 3,120 during the year. Also assume that PepsiCo sold property and equipment for 811 million in cash and there were no impairments. Question number 1 is asking us how much did PepsiCo originally pay for the property and equipment that was sold. This is just like the first case. We just go through how gross PP&E account changes. Ending gross PP&E is equal to beginning gross PP&E plus purchases minus original cost of the PP&E sold. Beginning and ending balance of gross PP&E as 36,818 and 39,166. These numbers are coming from, again, footnote number 4. Beginning numbers are last year and ending numbers are this year. The purchases are given in the question as 3,120. Therefore, if you do the algebra, you can calculate the original cost of the PP&E sold is 832 million. Part B of this question is asking you, at the time of the sale, what was the accumulated depreciation on the property and equipment that was sold? Just like the first case, we need to go through how accumulated depreciation account changes to tackle this question. Ending balance of accumulated depreciation is equal to beginning balance of accumulated depreciation plus depreciation expense minus accumulated depreciation of PP&E sold. So beginning balance of accumulated depreciation is 20,227. Ending amount of accumulated depreciation is 21,866. Where are these numbers coming from? Again, coming from footnote number 4, and there is a line just about accumulated depreciation. The next item we need here is the depreciation expense. For this year, it's going to be 2,227. And for this one, again, I'm looking at footnote number 4. At the end, there is a line for just depreciation expense. That's what I am using. And finally, if I do the algebra, I can calculate that the accumulated depreciation of the PP&E sold is 588 million. And here is case number 4 for long-term assets. Now we are going to look at financial statements of Blue Buffalo Pet Products. And we are going to make assumptions just like question number 2. What are these assumptions? There are no impairments. There are no additions or disposals of intangible assets. Some additions to plant, property, equipment are not paid in cash. So accordingly, what is the net book value of Blue Buffalo's property and equipment on December 31st, 2016? Net book value means the net value that you see on the balance sheet, and that's going to be 162,232. Where is this number coming from? I look at the balance sheet for year 2006, plant, property, and equipment net. This number is explicitly written as 162,232. And here's question number 2. Blue Buffalo has disposed of some property, plant, and equipment during fiscal year 2016. The sale price of disposed items was fully collected by the end of the fiscal year, and Blue Buffalo recognized a gain of 3,000 on the sale of these items. Here is part A of this question. What was the amount of accumulated depreciation and amortization associated with the property and equipment that has been disposed in fiscal year 2016? To answer this question, we again go through how accumulated depreciation account changes. Ending amount of accumulated depreciation is equal to beginning amount of accumulated depreciation plus depreciation expense minus accumulated depreciation of the disposed item, which is what we are after. The beginning amount of accumulated depreciation is 14,681. Ending amount of accumulated depreciation is 23,832. Where are these numbers coming from? These numbers are coming from footnote number 4. There's a line item just for accumulated depreciation. We need depreciation expense. That's going to be 9,200. Where is this number coming from? It is again coming from cash flow statement. Just like we mentioned in question number 2, cash flow statement operating section includes this number. And that number is 9,200. And if you do the algebra, you are going to find that accumulated depreciation of the disposed item is 49. Just one note here, depreciation expense for 2016 can also be found in footnote number 4. If you just look at here, at the end, there is a sentence here. It just tells the depreciation expense over the last 2 years. For year 2016, it is going to be 9,200, which is same as the number that you see on the cash flow statement. Part B, what was the original acquisition cost of the property, plant, and equipment disposed during fiscal year 2016? Again, we are going to use this alternative method to tackle this question. First of all, what is the net book value of the disposed item, which is equal to proceeds minus gain. The question tells me that when we sell this asset, we make a gain of 3. And how much money do we generate when we sold this asset? Again, I'm going to look at cash flow from investing activities. There's a line item called proceeds from the sale of fixed assets. It's going to be 15. And if you do the algebra, net book value of these assets at the time of sale is how much? 12. Does it make sense? You have an asset, its net book value is 12, you're selling it for 15, and therefore you make a gain of 3. It looks like it makes sense. And the second part, I'm going to use the identity. What does net book value means? Net book value is the difference between acquisition cost minus accumulated depreciation, or acquisition cost of an asset is equal to net book value plus accumulated depreciation. So net book value is 12. In the previous question, we calculated accumulated depreciation as 49. If you sum them up, we will find that the original cost of this disposed item is 61 in thousands. Part C of this question is same as before. How did the sale of plant, property, and equipment affect Blue Buffalo's cash flow from operations, and how did it affect Blue Buffalo's total cash flow? This item has no impact on cash flow from operations. Disposing an asset is nothing to do with our core operations. On the other hand, it increased the cash flow from investing activities and hence the total cash flow by 15 in thousands. And you can see this by looking at the cash flow statement. This is the cash flow from investing activities. There is a line item explicitly called for proceeds from the sale of fixed assets, which is 15. And here's part D. What was the value of plant, property, and equipment acquisitions that Blue Buffalo paid for in cash during fiscal year 2016? That number is 56,345. Where will I get this number? We are going to get this from cash flow from investing activities, because the question is explicitly asking you how much we paid in cash. So here is the cash flow statements. The first item is capital expenditures. Its value is 56,345. And finally, what was the value of additions to plant, property, and equipment during fiscal year 2016? To answer this question, we need to go through how gross PP&E account changes. Ending gross PP&E is equal to beginning gross PP&E plus additions minus original cost of sold or disposed items. Beginning amount of gross PP&E is 129,841. Ending amount of gross PP&E is 186,064. Where are these numbers coming from? They are coming from footnote number 4. Note that we are dealing with the gross numbers, therefore these numbers do not include accumulated depreciation. So we are after the additions in year 2016. We don't know that. And what is the original cost of the disposed item, which we have calculated 61. And if you do the algebra, you're going to find that total additions to plant, property, and equipment in this year is 56,284. This completes my discussion of cases about long-term assets. Thank you.
The University of Illinois was formed about 150 years ago with a land grant mission to democratize education. The IMBA is a testament to that mission. We are about access to education. We are looking for talented people around the world across a variety of socioeconomic backgrounds and demographic characteristics to constitute our classes because we believe the heterogeneity in background, heterogeneity in talented people will be fantastic for the IMBA, not only in terms of our visibility, but also in terms of enhancing the experiences of our students. And so what we have done is we are providing the opportunity to people around the world, talented people around the world, to complete a high-quality MBA education for about $20,000. So if you are talented and if you are eager to grow, then we want you to be a part of the University of Illinois family.
Hello, welcome to Financial Accounting Advanced Topics here at University of Illinois. As you might remember, a balance sheet has three main components. These are assets, liabilities, and shareholders' equity. Today, we are going to discuss the liabilities section. Here is a brief overview of what we are going to do today. First, we are going to talk about recognition of liabilities. And then we will discuss valuation of liabilities. And finally, we will go through accounting for liabilities. So what's a liability? Liabilities are sacrifices to transfer economic benefits because of some past transactions. Not everything is a liability. In order for something to be a liability, it has to satisfy two criteria. First, it needs to be measurable. It means that you need to be able to attribute a value to this liability. And second, it needs to be because of an executed contract. It means that the liability should be because of some past transactions. What are some examples? We have accounts payable, utility payable, unearned revenue, bank loans, and bonds. These are some examples of liabilities. So how do we value liabilities? Valuation of liabilities depends on what type of liabilities we are talking about. For short-term liabilities, these are liabilities that needs to be paid within a year. Life is easy. They are valued at face value. Suppose that firm X owes $100 to firm Y, then firm X will show as a liability $100 in its balance sheet. So there is no discounting, no reduction, anything. It's just whatever you owe will show up on the liability section of a balance sheet. On the other hand, for long-term liabilities, these are liabilities which needs to be paid in a time period more than 1 year. The situation is a little bit more complicated. Here, we need to calculate present value of future obligations. And I'm going to discuss present value calculations soon. We have two types of liabilities. The first one is short-term liabilities. Under short-term liabilities, we are talking about obligations that needs to be fulfilled by the firm within a year. What are some examples? Accounts payable, wage payable, utility payable. As long as they are paid within a year, they are a part of short-term liabilities. And how do we value short-term liabilities? As we discussed in the first lesson, short-term liabilities are valued at their face value. Here is a small example about short-term liabilities. We have a firm which purchased inventory for $15,000 that in credit, that's why it's a liability, and which needs to be paid in 6 months. Therefore, it's a short-term liability. How do we record this transaction? First of all, we are buying inventory. Inventory is a type of asset. Therefore, there is an increase in the asset side by $15,000. Similarly, in the liabilities section, we have an increase of $15,000. And under what account we record this liability? We are going to record this under accounts payable. Since it is going to be paid within 6 months, then this accounts payable is a short-term liability. One thing very important here is that to look at in terms of valuation, in terms of numbers here, there is no discounting, no reduction. Firm buys inventory for $15,000, and that is exactly what shows up in these accounts. The second type of liabilities we are going to talk about today is long-term liabilities. Under long-term liabilities, we are talking about obligations that needs to be fulfilled by a firm in a time period more than 1 year. What are some examples? Bonds, long-term bank loans are some examples. Valuation of long-term liabilities is quite complicated. Under long-term liabilities, we need to calculate present value of all future obligations. Present value is a very important topic. It's a topic of corporate finance. It is a long topic. Therefore, in this class, we are going to take a shortcut. The shortcut is that we are going to talk about a particular type of a long-term liability where you don't have to calculate present values. I'm going to discuss this soon. Probably the most important type of long-term liability that we are going to talk about in this class is bonds. So what's a bond? Bond is a loan where there is a borrower, a lender, and borrower borrows some money from the lender. In return, borrower commits two types of payments to the lender. First, borrower makes some periodic payments to the lender, and we call these periodic payments as coupon payments. Most of the time, these payments are made in every 6 months, so they are paid semi-annually. And second, the borrower pays at the end of the life of this bond, which we call as maturity, all of the original amount of borrowing. We call this original amount of borrowing as principal. So one more time, what's a bond? It's a loan, and because of this loan, the borrower pays lender two things: periodic payments, so these are coupon payments, and repayment of all of the principal at the end of the maturity of the bond. Bonds are very interesting instruments, just like stocks. They are traded in the market. So basically, you can go ahead and buy a bond and become a bondholder of a firm. Whenever you become a bondholder of a firm, you are going to get bond certificate. On the bond certificate, you will have information about at least three things. First, you are going to have information about maturity day. In other words, what is the life of this bond? Bonds can be issued for 5 years, 10 years, 15, 20. It is according to between the borrower and the lender. The second information that you will get when you have a bond certificate is face value, which is the principal. It is the amount of original borrowing. It's going to be written on this bond certificate. And finally, when you are a bondholder, you will have information about coupon rates. Coupon rates are annual interest rates. They are quoted in annually, but most of the time they are paid semi-annually. So how do we price bonds? Bonds are priced according to present value because they are long-term liabilities. So under bond pricing, we need to calculate present value of future coupon payments. We need to also calculate present value of repayment of the principal, and then we need to sum them up. But as I mentioned before, present value calculations is a long topic. It is also a topic of corporate finance. In this class, we are going to take a shortcut. The shortcut is that I'm going to talk about a particular type of bonds. These are par bonds. Under par bonds, you do not have to calculate present values. Under par bonds, we have bonds. The price of the bond is equal to its face value, the original amount of borrowing. So there is no present value calculations for par bonds. Is par bonds a big deal? It is. In fact, if you look at the market, most of the bonds are issued at par. So basically, by looking at par bonds, we are not really losing much information. So how do we do the accounting for bonds? Well, first of all, we need to issue bonds and we need to go through accounting at the time of issuance. As you might remember, we are talking about par bonds. Under par bonds, what do we have? We have a price of a bond which is equal to face value, and similarly we have a bond payable which is equal to bond face value. So at the time of issuance, what type of accounting we are going to do? Obviously, the firm borrows money. There is a cash infusion. Cash will go up. At the same time, the borrower will create a bond payable, and whose amount will be same as face value. Let's see an example. Here we have a firm issuing a bond whose face value is $5,000. The coupon rate is 10%, but it is going to be paid semi-annually, so in every 6 months. Issuance date of this bond is January 1st, 2015, and the life of this bond is 5 years. So the maturity will be 5 years. So what is the accounting at the time of issuance? Obviously, at the time of issuance, which is January 1st, 2015, the firm generates $5,000. Therefore, cash increases by $5,000. Similarly, there is a bond payable accounting created. It is also $5,000. Notice here that we are talking about par bonds. Therefore, we didn't calculate any present value. all we are doing here is that bond payable amount is same as the face value. Okay? Now we did the accounting for issuance. So how do we do the accounting after this time? Because we know that we are dealing with a bond which has a life of 5 years. Well, we know that bonds have two types of payments. First, there will be periodic coupon payments. Under periodic coupon payments, there will be a reduction from the cash because you are paying some interest. And then you need to record some interest expense on income statement. So how do we do this? We issued this bond January 1st, 2015. And we know that this bond has a coupon rate of 10%, which is paid semi-annually. Therefore, at the end of the first 6 months, which is June 30, 2015, we need to pay some coupons. What is the size of this coupon payment? Well, we know that the face value of this bond is $5,000. We know that annual coupon rate is 10%, but we know that these coupons are paid semi-annually. Therefore, I am dividing this by 2. And if you do these calculations, you will find that the coupon payment for every 6 months is $250. It is paid to lenders. And at the same time, we create an interest expense on the income statement, and you notice that it is also $250. It is in parentheses, it is an expense. So what happens next? One more 6 months pass. Now we are at the end of year 2015. Therefore, we need to pay back one more coupon, and the transaction will be similar. Again, there is a cash reduction of $250, and again, there is an interest expense of $250. And you're going to do this for the next 5 years. We know that the coupons are paid semi-annually. It means that you need to pay 10 coupons. Then what is the bond accounting at the time of maturity? Well, at the time of maturity, you need to do 2 transactions. First, you need to pay the last coupon, and second, you need to pay all original amount of borrowing. So how are we going to do this? Again, if I go back to my question, I have a bond whose face value is $5,000, annual coupon rate of 10%. It has a life of 5 years. So this firm will make 10 coupon payments. And if you look at the last row here, at the end of year 2019, I'm going to make the last coupon payments. There is a cash reduction of $250. There is also an interest expense on the income statement of $250. But now we are at the end of this bond. We are at the time of maturity. At the time of maturity, then the borrower needs to pay back all $5,000. How are we going to do this? There is a cash reduction of $5,000. And similarly, notice that bond payable account is removed. We put a minus $5,000 under bond payable. So from now on, bond payable account disappears. So if you summarize, how do we do the bond accounting? Well, bond accounting involves 2 things. You need to make coupon payments, you need to record them, and at the end of the maturity, you need to also record repayment of the original amount of face value. So here is a brief summary of what we have done in this module. First, we talked about recognition of liabilities. And then we discussed liability valuation. And finally, we discussed accounting for short-term and long-term liabilities. In the next session, we are going to talk about accounting for shareholders' equity. Until that time, take care. Hello, in this video, I'm going to introduce you time value of money. Time value of money is a finance topic. However, we need to know this topic to understand appendix number 2 and 3. If you have taken a corporate finance class before, and if you are familiar with the concepts of like a present value of an annuity, present value, future value, you do not have to watch this video. On the other hand, if you have never taken a corporate finance class, it's a good time to learn time value of money, which is going to be useful in appendix number 2 and appendix number 3 of liabilities. If you're ready, let's get started. The first concept that I'm going to introduce you is something called future value. The idea here is that the value of $1 million today is different than the value of $1 million, for example, 20 years from now on, due to mainly 2 reasons. 1, inflation in prices. One can buy less goods and services with $1 million in the future than she can buy right now with again $1 million. And we can see this in our lives too, right? Today, let's say a car is $50,000. That car will not be $50,000 20 years from now on because of increase in prices. So if you're buying, for example, 20 cars right now with $1 million, in the future, probably you are going to buy 15 of the same cars. Okay, this is all because of inflation prices. The second reason why the purchasing power of the money is changing across different times is opportunity cost. One can invest $1 million today and earn return on this investment, potentially ending up with more than $1 million in the future. Therefore, $1 million in the future has a different purchasing power than $1 million in today. So why do we need this concept? Okay, how I can apply this concept? You can apply this concept to find the value of a certain amount of sum today in the future. For example, what is the value of $1,000 in 3 years from now on? Assume that the interest rate or discount rate is 9%. I'm going to use interest rate and discount rate terms interchangeably. So in year 0, this is today, we have $1,000, and I'm asking you what will be the value of this money in 3 years from now on. Then how am I going to do this? Okay, and now let's go step by step. In the first line, you see that the value of $1,000 in year 1, okay, we have $1,000 today, but what is the value of this $1,000 from 1 year from now on? It's going to be what? 1,000 times 1 plus 9%. 9% is your interest rate. You are going to end up with $1,090. So what's going on here? Well, 1 year from now on, if I put my money of $1,000 into a bank account, I'm going to still have $1,000. Plus, I'm going to have 9% interest. 9% times 1,000 is going to give you 90. Therefore, 1 year from now on, your $1,000 will be $1,090 in your bank account. How about the value of $1,000 in year number 2? Well, it's the same thing, but we are going to do these future value calculations twice. So you are going to multiply 1,000 with 1 plus 9% 2 times. And then if you do this, you're going to find that the value of 1,000 today is 1,188 2 years from now on. And our question is asking you, what is the $1,000 from 3 years from now on? Basically, you are going to multiply 1,000 with 1.09 3 times. And then you're going to find that 1,000 today is equivalent, in terms of its purchasing power, 1,295 3 years from now on. This process is called also compounding. So you are earning interest on interest, right? In the first year, for example, your 1,000 becomes $1,090. In the second year, you not only earn interest of original $1,000 plus interest of $90, and so on and so forth. Okay, this process is called compounding. So is there any way to automate this process? Do we need to do this one by one like this? Not really. Actually, we can come up with a formula to calculate future value of a certain sum today, and the formula is as follows. FV is equal to PV times 1 plus R to the power of N. So what are these terms here? FV is equal to future value, PV is equal to present value, R is our interest rate. In my example, it is 9%, so it is 0.09. N is number of years compounding. So in our example, we are interested in the value of $1,000 from 3 years from now on. Therefore, we are raising to the power of 3. And let's just apply this formula. FV is equal to 1,000 times 1 plus our interest rate of 9% to the power of 3 is going to give you 1,295. This is exactly what we have calculated in the previous slide. And this is the formula for calculating the future value of a certain sum today. So what it says here is that in terms of purchasing power, today's $1,000 is equal to 3 years later's value of 1,295. In terms of purchasing power, these numbers are the same. The second concept that I'm going to introduce you is something called present value. Present value is the opposite concept of future value. And here we are going to ask the question of what is the current value of a future amount, okay? So we have a certain number of money in the future. I'm asking what is the purchasing power of that money today. Let's just give you an example. What is the present value of $5,000 in 3 years from now on? Assume that the interest or the discount rate is 8%. So we have $5,000 in year number 3. I am interested in what is the purchasing power of this $5,000 in year 0. Well, we are going to do the opposite of what we have done for future value calculations. For example, the value of $5,000 in year 3 in terms of purchasing power is equal to in year 2 to what? 5,000 now divided by 1 plus the interest rate of 8%. So you're going to find that it is going to be 4,630. So in terms of purchasing power, year 3 amount of 5,000 is equal to year 2 value of 4,630. Okay, what is the value of $5,000 in year 1? Well, we are going to basically divide by 1 plus interest rate now twice. And if you do this, you're going to find that the value of $5,000 in year 1 is going to be 4,287. And finally, if you are interested in the purchasing power of today, which is 3 years ahead's money, the value of $5,000 in year 0 is going to be 5,000 divided by 1 plus interest rate, and you are going to divide by 3 times. And you're going to find that the number is 3,969. So what does it say? Either you have 3,969 today, or in year 3 you have $5,000. In terms of purchasing power, these two sums are the same. Okay, 5,000 in year 3 is equal to 3,969 today in terms of its purchasing value. This process is called discounting. We are discounting a future cash flow, which is $5,000 in my example, to today. Can we automate this formula? Yes, just like what we have done for the present value, future value, we can come up with a present value formula. So present value is equal to PV, FV, which is future value, divided by 1 plus interest rate of R to the power of N. In the previous formula, when we were calculating the future value, we were multiplying by 1 plus R to the power N. Now, since we are calculating present value, we divide by 1 plus R to the power of N. So if we apply this formula to our previous exercise, present value of $5,000 is equal to 5,000 divided by 1 plus interest rate of 8% to the power of 3, because we are going to get $5,000 3 years from now on, and you're going to find it is going to be 3,969. The next concept that I'm going to introduce you is something called annuity and present value calculations for an annuity. Annuity is a series of equal payments in certain intervals. For example, $100 of interest payments in every month over the next year. So over the next year, there are 12 months. Every month, suppose that you are going to pay $100. So the question here is, what is the present value of an annuity, a series of payments? Well, the answer is one can calculate the present value of each payment and then sum the discounted payments. Okay, we already know how to calculate present value. In the annuity, we have many numbers. So you're going to calculate each of their present value, and then you're going to sum it up. Let's just see an example. What is the present value of $2,000 received in each of the next 3 years? Assume that the interest or the discount rate is 5%. So I am going to calculate the present value of each of these 2,000s as of today. For example, we have a $2,000 in year number 3. What is the present value of this year 3 $2,000? It's going to be 2,000 divided by 1 plus our interest rate of 5% to the power of 3. It's going to be 1,728. Similarly, what is the present value of $2,000 in year number 2? It's 2,000 divided by 1 plus again interest rate of 5% to the power of 2. It's going to be 1,814. And again, what is the present value of $2,000 in year 1? It's going to be 2,000 divided by 1 plus 5% to the power of 1. So you're going to find 1,905. So to calculate the total present value, you're just going to sum these 3 present values. You're going to sum 1,728, 1,814, 1,905. You're going to find that the present value of all of this $2,000 over the next 3 years is equal to 5,447. So in terms of purchasing power, either you give me today 5,447 or you give me $2,000 at the end of each year over the next 3 years. They are going to be the same. So there is a problem here. As you see, this calculation is very tedious, all right? And here we have 3 years. That looks reasonable, but suppose that I have equal amount of payments over the next 20 years. It's very tedious to calculate a one-by-one present value. Is there a formula that we can use for the present value of an annuity? Yes, we can. You can calculate present value of an annuity with the following formula. PV is equal to PMT. PMT stands for payment. In my example, it is $2,000. And then there is a big parenthesis, a lot of terms going on here. 1 minus 1 plus r of interest rate to the power of minus n. In my example, n is 3 years divided by r. So you don't have to worry about where this formula is coming from, okay? This formula will help us to calculate present value of any annuity. Let's just apply. In my example, present value is equal to 2,000, which is the amount of payment, times, in the big parentheses, 1 minus 1 plus discount rate of 5% to the power of minus 3 divided by my discount rate of 5% is going to give you exactly the same number. This formula looks very unmanageable, but remember, you can use Excel to calculate this amount, okay, what is in the parentheses, and you don't have to know how this formula is driven, okay? This formula can be used to calculate present value of an annuity, like our example, and it's going to be very handy if you have a lot of similar amount of payments in the future. So then the question here is, why are we learning all this, right? From an accounting perspective, why do I care about this present value, future value calculations? In appendix number 2 and appendix number 3, I am going to discuss with you advanced issues in bonds and then the leases. These two topics require you to know present value calculations. Let me show you how we are going to learn, how we are going to apply what we have learned so far to some examples in bonds. Okay, let's just look at here. Here's example number 1. What is the current market value of a bond with the following features? Okay, I have a bond with the following features. Its face value or principal value is 5,000. Coupon rate is 10%, which is paid semi-annually. Interest rate or our discount rate is 8%. Issuance date or today's date is January 1st, 2015, and this bond will mature in 5 years. So the question is asking you, what is the current market value? And we know that current market value or the price of a bond is equal to total present value of future cash payments associated with this bond, okay? I'm going to identify the cash flows of this bond. I'm going to take their present value. It's going to give me current market value or the price of this bond that I need to put on my balance sheet. So let's just see what's going on. Here is my graph. So today we are interested in present value of all the future cash flows. Therefore, in period number 0, okay, we have a question mark. So this is a bond with 5 years, and all the payments are semi-annual, suggesting that we have 10 periods. In every period, we are supposed to pay some coupon. And what's the coupon rate? It's 10%. What is the each coupon amount? As we have calculated in the third line over there, 5,000, that's the face value, times the coupon rate of 10%, divided by 2, it's going to give you 250. You see, over the next 10 periods, I associate with this coupon, if I invest in this bond, I am going to get $250. Plus, another feature of the bonds is that in the last period, in my example, it is period 10, you are going to also get the face value of this coupon. It's going to be $5,000. Therefore, if you look at period number 10, the amount of payment I'm going to get is not just $250. It's going to be $5,250, which comes from two sources. $5,000 is the original face value, and $250 is my last coupon payment that I'm going to get. One thing I want to mention here is that in the question, interest rate is given as 8%. Okay? Since we are using semi-annual calculations, my discount rate or interest rate is going to be 4% semi-annually. So, are you ready to calculate the present value of these future cash flows? Well, what can you do? You can calculate these 10 payments present value one by one. But as you can imagine, it's going to be very tedious. Is there any formula that I can use so far I learned? Yes. If you look at these 10 payments, they are following a pattern. What? For example, over the next 10 periods, I am going to get $250 in each period, suggesting that I can use the present value of an annuity formula for this coupon payments. Plus, in period number 10, I'm going to get an additional $5,000. It is going to be my present value. Okay, I can use the present value calculation formula that I have learned before. I can apply to this $5,000 and I can calculate just the $5,000 present value. So let's just apply. Bond price, as we have learned, is the sum of present value of future coupon payments and principal payments. So what is the present value of this principal that we are going to get in period number 10? Well, present value is, I'm now applying the present value formula that we have seen. Present value is equal to 5,000 divided by 1 plus my interest rate of 4%. It's 4% because everything is semi-annual. to the power of 10. Why? Because I'm going to get this $5,000 10 periods from now on. So you're going to find 3,378. How about the present value of the coupon payments, 10 coupon payments? I am going to use the present value of annuity formula. If you compare this with the formula, it's exactly the same thing. This is the present value of $250 of annuity over the next 10 periods. And what is my interest rate? 4%. And if I apply the present value of the annuity formula, please just check, confirm that this is the formula that you have learned in the previous slides. You're going to find that present value of this 250s over the next 10 periods is equal to 2028. And if you sum these two values, 3,378, 2028, you are going to find that the value or the price of this bond is equal to 5,406. So basically, if I want to invest in this bond today, I need to pay, to be an investor, 5,406. And if this firm is selling this bond to the public, for each bond, they are going to raise 5,460. This is going to be their bond payable. Let's do another example. What is again the current market value of a bond with the following features? Everything is the same except what? Interest rate is different. In the previous question, interest rate was how much? 8%. Now it is 12%, suggesting that in every 6 months, interest rate or our discount rate is 6%. Okay? Can we calculate again the present value of this bond? Sure. We can use the technology that we have learned in the previous exercise. Everything is the same except that for every 6 months your interest rate is just 6%. Over the next 10 periods, every period you get $250 as an investor, and in period number 10 you get $5,000. Now I'm going to calculate the present value of these future cash flow streams. First, let me calculate the present value of the principal of $5,000 in period number 10 from 6% discount rate. 5,000 divided by 1.06 to the power of 10. It is 6% because the market or interest rate is 12%. And we are using semi-annual calculations. Therefore, the present value of $5,000 from 6% interest rate is how much? 2,792. Similarly, present value of the future coupon payments. There are 10 coupon payments of $250. Each of these coupon payments will be discounted from 6%. You're going to find it's going to be 1,840. And if you sum these two values, present value of the principal of 2,792, present value of coupon payments of 1,840, you are going to find that the value of this bond, the price of this bond is equal to 4,632. You see, we can use the present value or future value formulas that we have used or learned in the previous section to apply to bond exercises. And this technology will be very useful when you're listening appendix number 2. So please stay tuned. The last concept that I'm going to introduce you is something called IRR. Sometimes we are given present value of a stream of future cash flows, and we are asked the interest or the discount rate which makes the present value of future cash flows equal to our given present value. This special rate is called IRR. I understand that the language is a little bit tough. Let me just give you an example to see what I'm talking about. Suppose that today, December 31st, 2018, there is a firm called Firm A, and it will make the following payments on the following dates. In December 31st, 2019, which is 1 year from now on, they are going to pay 100. In 2 years from now on, they are going to pay 150. 3 years from now on, they will pay 500. And 4 years from now on, they are going to pay 50. Suppose that somebody gives me the present value of these future payments as 625. So you don't have to worry about where it's coming from. Suppose it's given. The question here is, what must be the discount or interest rate? But as you can see, this question is very different than what we have learned so far. In the previous exercises, we have the future cash flows, we have the discount rate, we calculate other future value or the present value. Here, we are given present value, we are given future cash flows, and our job is to calculate the discount rate. How am I going to do this? Well, the problem here is that the future cash flows do not have a pattern. We do not have an annuity here, okay? Sometimes we are paying 100, sometimes 150, so on, okay? There is no pattern. So luckily, Microsoft Excel has a function called IRR, that can be used to calculate the discount rate. So how am I going to do? You are going to set up an Excel sheet as follows. So please open an Excel, Microsoft Excel, and set up your sheet exactly what you see on your screen. For example, in C number 2, in cell number C2, you write 100. In D2, write 150. In E2, write another payment of 500. And in F2, you write the last payment of 50. And in B2, write the present value. But present value needs to be in minus sign. That is what the Microsoft Excel requires. That is how it understands that 625 is the present value. Then what am I going to do? I'm going to go to cell B3. I'm going to write the following formula. Equal to, equal sign, IRR. You are going to open a parenthesis, and you are going to underline all the numbers between B2. B2 is my present value in minus sign, and F2, which is the last payment that firm A will make. And then if you hit on enter, you're going to find that the discount rate associated with this question is going to be 10%. In other words, if you discount the future cash flows of 100, 150, 550 from 10%, you should be fine 625. Would you like to check this? Let's just check this. What is the present value of the following payments as of December 31st, 2018, which is today? Suppose that interest rate or the discount rate is 10%. Okay, let's just do this one by one. What is the present value of $100 in year 2019? Well, this is going to be 100 divided by 1 plus the interest rate of 10% to the power of 1. You are going to find 91. What is the present value of 150? 2 years from now on, it's going to be 150 divided by 1 plus 10% to the power of 2. You're going to find 124. What is the present value of $500? 3 years from now on, it's going to be 500 divided by 1 plus 10% to the power of 3. You're going to find 376. And finally, what's the present value of 50 4 years from now on? It's going to be 50 divided by 1 plus interest rate of 10% to the power of 4. You're going to find 34. And if you sum these four present values, 91 plus 124 plus 376 plus 34, you are going to find 625. So IRR is a very useful technology that we can use when we are covering leases. And when we are covering leases, you are going to see that firms provide future lease payments. They also provide current market value or the present value of these lease payments. And therefore, in those exercises, I'm going to ask you, what must be their discount rate to associate with these leases? So to answer those questions, you are going to need this framework of IRR. So overall, I hope that you find this appendix very useful. As I said, the present value, future value calculation is nothing to do with accounting. That's a finance topic. But unfortunately, we need this topic to understand appendix number 2 and appendix number 3. If you have taken corporate finance class, you already know this stuff. If you have never taken it, I hope this video is useful to you. Thank you. In this lesson, I'm going to introduce you some special type of liabilities that you can come across from time to time. The first special liability I'm going to discuss with you is contingent liabilities. Contingent liabilities are obligations that might be fulfilled by the firm in the future. In other words, contingent liabilities may or may not exist in the future, and even if they do exist in the future, we may not precisely know their amounts. An example is lawsuit penalty. Whenever a firm is sued for, let's say, an environmental damage, first of all, the firm doesn't know whether the firm is going to lose this lawsuit. And second, the firm doesn't know, even if the firm loses the lawsuit, how much it will be the amount of net and final penalty. So how are we going to value these contingent liabilities in financial accounting? If the likelihood of occurrence is remote, we are going to ignore this contingent liability. In other words, if the likelihood of losing this environmental lawsuit is remote, we just ignore. If the likelihood of occurrence is possible, we are going to disclose the contingent liability in a footnote. And finally, if the likelihood of occurrence is probable, we are going to create a contingent liability. The problem here is that there are now guidelines on what remote, possible, or probable means. So who is going to be the judge here? It's going to be auditors. Auditors are going to make a decision about whether we are going to lose this environmental lawsuit and whether the probability is remote, possible, or probable. Let me please give you an example. A firm is sued for $10,000 due to environmental damages. The firm estimates that it will probably lose the lawsuit. So coming back to the previous slide, this is a probable occurrence case. If it is probable, we are going to create a contingent liability. So how are we going to do this? As soon as lawsuit is opened, we are going to create a liability of $10,000, which we are going to call it as contingent liability. And then on the shareholders' equity side, under income statement, we are going to create a loss from contingent liability of $10,000. Suppose that lawsuit concludes with a $7,000 penalty for the firm. How are we going to do the accounting for this? First, we are going to pay $7,000. Therefore, from cash, there will be a reduction of $7,000. We are going to remove contingent liability of $10,000. There is no more contingent liability. We already paid $7,000. This liability is gone. It's not going to balance. To make it balance, under shareholders' equity, we are going to create a gain from contingent liability of $3,000. And net, basically, last year we took a loss $10,000. This year we took a gain of $3,000. Net, this environmental lawsuit costed us, as an expense, $7,000. Next, I am going to introduce you warranties. Warranties are promises given by firms to the buyers to fix or replace a product sold. They are usually given for a certain period of time, 1 year, 2 years. If future warranty costs are large and could be reliably estimated, warranties need to be recognized in financial statements. Let's do an example. A firm sells 5 bicycles on January 1st, 2015 for $200 each. Each bicycle is sold with a 2-year warranty. The firm estimates that each bicycle will have a warranty cost of $15 each over the 2-year warranty period. The firm spends $30 in 2015 for warranty claims. First, let's just book accounting for selling of these bicycles. There are 5 bicycles. Each of them is worth $200. Therefore, cash goes up by $1,000. And then under shareholders' equity, revenues goes up by $1,000. For the sake of simplicity, assume that there is no cost of goods sold. Of course, there will be a cost of goods sold, but let's just say it doesn't exist, just to make everything easy. As soon as we book the sale of these bicycles, we need to also create warranty provision. What is the size of this warranty provision? Because we estimate that every bicycle might cost us $15 in the future to fix, and there are 5 bicycles sold. The amount of warranty provision, which is a liability, is 15 times 5. It's going to be $75. And then you are going to create a warranty expense under shareholders' equity of, again, $75. Notice that we are creating this warranty provision as soon as we sell the bicycles, as soon as we book the revenue associated with bicycles. And finally, in year 2015, our firm spends $30 to fix some of these bicycles. Therefore, from cash, there is a reduction of $30, and from warranty provision, there is a reduction of $30. So whenever we actually fix these bicycles, there is no impact on income statement. Income statement has already been hit by $75 as soon as we created the warranty provision. When we fix the bicycles, all that happens is there is a reduction from warranty provision account. Suppose that the firm spends no money on warranty claims next year, which is 2016. So here I provided you the ending balance of last year. So ending balance of asset from last year is $970. Where is this coming from? we created a revenue of $1,000, and then we spent $30 to fix some of these bicycles. Net in cash account we have $970. Liabilities is $45. Where is this coming from? Well, we created an initial warranty provision of $75. $30 has been used, therefore the remaining amount of warranty provision is $45. And finally, the amount of shareholders' equity will be $925 on the income statement. Where is this coming from? It's coming from the fact that we booked a revenue of $1,000, and then we also had a warranty expense of $75. So it looks like that in next year we have no impact on warranties. It means that at the end of the year we need to close this warranty provision because this is a 2-year warranty. So how do I close the warranty provision? You see that there is a minus warranty provision of $45, and similarly we create a gain from warranties of $45 on income statement. Therefore, warranty account is closed. The third group of special liabilities that I'm going to introduce you is third-party collections. These are collections of money by firms from customers for other parties. A very famous example here is sales tax. Whenever, as a consumer, we buy some goods, we pay tax, and those taxes are collected by grocery store or any other store, which are transferred to government sometime later. Most of these third-party collections are short-term liabilities for firms which collect this money. Let's do an example. A firm sells a car for $20,000, which includes a sale tax of $1,000. Tax collections are transferred to the government at the end of every month. Let's book this sale. Cash goes up by $20,000. The revenues goes up by $19,000. Why it is 19? Because out of 20, 1,000 belongs to the government, and for that $1,000, I'm going to create a new liability, which is sales tax payable. And then when we pay this sales tax to the government, sales tax payable is removed, and similarly there will be $1,000 reduction from our cash account. The next special liability I'm going to discuss with you is bank loans. These are money borrowed from a bank for a specific duration from a pre-specified interest rate. Loans can be short-term or long-term liabilities depending on their duration. Let's do an example. Company A borrows $5,000 from Illini Bank for 6 months for an annual interest rate of 10%. Notice that this is a 6 months borrowing, therefore it's going to be a short-term liability. How are we going to do the accounting for this? One, let's obtain the loan. Cash goes up by $5,000, and then you create a loan payable of $5,000 under liabilities. And after 6 months, whenever we are repaying these loans, first of all, we get rid of loan payable. It's closed. That is minus $5,000. Second, we need to calculate the amount of interest that we are supposed to pay the bank after 6 months. How do we do that? Well, the amount of borrowing is $5,000. The annual interest rate is 10%, suggesting that 6 months interest is just 5%. So 5% times 5,000 is going to give you $250 of interest expense. So what do you pay to the bank? You pay $5,000 original borrowing plus $250 of interest expense. So therefore, cash reduction will be $5,250. In this video, I'm going to discuss with you some advanced issues in bonds. In a previous lesson, we have already covered how we are going to do the bond accounting for some simple bonds. Now we are going to deal with some more sophisticated issues associated with bonds. Bond pricing. We have seen that most bonds are issued at par value. However, due to changing market conditions between the coupon amount determination date and the date the bond is issued to the market, bonds might be sold more or less than the par value. If you can remember, bond price is equal to sum of present values of future coupon and principal payments. Therefore, it's possible that some of these bonds can be issued at premium. What's a premium bond? If the market effective interest rate is lower than the coupon rate, the bond is issued at premium. In other words, the bond price is higher than the par value. On the other hand, if the market interest rate is higher than the coupon rate, the bond will be issued at a discount. It's going to be a discount bond. For a discount bond, the bond price is lower than par value. In other words, bond price is determined by the interplay between market effective interest rates and coupon rates. As we have seen in a previous video, if the market rate is equal to coupon rate, we are going to have a par bond. On the other hand, if the market rate is less than the coupon rate, it's going to be a premium bond. If the market rate is greater than coupon rate, it's going to be a discount bond. Premium or discount bonds bring more, or if it is a discount, it's going to bring less cash to the issuer than the par value. So let's do an example, just to make sure that we are on the same page. To understand premium and discount bonds, you need to know discounted cash flow calculations. If you don't know, I suggest you look at some online resources to learn the basics of how we are going to do the discounting. Here is my example. Suppose that we have a bond, its face value is $5,000. Coupon rate is 10%, which is going to be paid annually, semi-annually. Market rate is 8%. Issuance date is January 1st, 2015, and also this bond has a life of 5 years. Since market rate is lower than the coupon rate, this is going to be a premium bond. Market rate is 8%, coupon rate is 10%. How do we price a premium bond? We are gonna use the framework that we have already discussed in a previous video. Bond price is equal to sum of present values of future coupon and principal payments. So let me start with calculating the present value of the principal payment. It's going to be $5,000. Market interest rate is 8%. Since we are doing semi-annual calculations, it's going to be 4%. And then if you discount this over the 10 period, you're going to find that $5,000 five years later is worth today $3,377.8. Next, we are going to calculate the present value of the coupon payments. So notice that it is 5 years bond. There are 10 coupon payments. What is the size of each coupon payment? It's going to be 5,000 times 5%, because annual coupon rate is 10, so semi-annual coupon rate is 5%. And then we have 10 payments. If you calculate their present value, you're going to find $2,027.72. And if you sum these two numbers, present value of the principal, present value of coupon payments, you're going to find that the value of this bond today is $5,406. Notice that it's a number greater than $5,000. Why? Because this is a premium bond. So how are we going to do the accounting associated with this bond? First, at the time of issuance, which is January 1st, 2015, cash will go up by $5,406. Bond payable will be created as $5,000. That is the face value of this bond. So what am I going to do with this additional $406? I'm going to create a special account under liabilities, which is going to be called as bond premium, $406. So what happens to the premium bond after issuance? We are going to decrease the cash account on balance sheet by bond interest payment. In other words, by bond coupon payment, which is going to be calculated as face value times coupon rate. We are going to also decrease income statement by bond interest expense, which is going to be calculated as beginning amount of bond payable times market interest rate. It is 8% annually, 4% semi-annually. And then to decrease the bond premium account by the difference between bond interest payment, which is coupon payment, and bond interest expense. So let's see this in action. After 6 months, June 30, 2015, we are supposed to make our first coupon payment. The amount of first coupon payment is $250, which is reduced from cash. Why it is $250? Annual coupon rate is 10%. Semi-annual coupon rate is 5%. 5% times the face value of $5,000 is going to give you $250. What is the amount of interest expense, which is going to be on the right-hand side? It is equal to 4%, which is half of the market interest, times the amount of beginning bond payable plus bond premium. So if you notice that at the beginning of this first coupon payment, the amount of total liabilities associated with this bond is $5,000 bond payable plus $406 of bond premium. So $5,406 times 4% is going to give you an interest expense of $216.2. As you see, it's not going to balance. To make it balance, you are going to reduce $33.8 from the bond premium account. Let's do this one more time. Now we are at the end of year 2015. What is the amount of coupon payment? It doesn't change. It's still $250 per 6 months. But what is the amount of interest expense? Let's remember the formula. It is beginning amount of bond payable, everything associated with this bond, times 4%. So what is the beginning amount of bond payable? Now it is $5,406 minus 33.8, which has been amortized 6 months early, times 4% is going to give you a new interest expense of $214.9. Again, it's not going to balance. To make it balance, you are going to reduce the amount of bond premium by $35.1. And you can continue like this. In fact, if you continue, you can come up with an Excel sheet and you can just see the amount of bond premium amortization, the amount of interest expense, the amount of coupon payment over the next 10 periods. In other words, you can come up with an amortization table for a premium bond just like what you see in front of your screen. So let me just go through what's going on here. In the first column, we have periods, period 1, 2, 3, up to 10. It's a 5-year bond. There are 10 6-month periods. Beginning net book value of this bond is initially $5,406, but we know that the value is going down. Why? Because there is an amortization of premium. Interest expense is always equal to beginning net book value of this bond times 4%. You can come up with an Excel sheet like this. And the next column is coupon payment. It never changes. It is always $250. The difference between $250, which is coupon payment, and interest expense, is going to give you premium amortization. As you see, every 6-month period it is different. Finally, we can come up with the ending amount of premium. The initial amount of premium is $406. After the first coupon payment, the amount of ending premium will be $372.2. It will go down, down, down. But notice that at the end of period 10, there is no more premium. And finally, we can come up with the ending net book value of this bond, which is equal to beginning net book value of this bond minus premium amortization. So at the end of the first coupon payment, the amount of new ending net book value will be $5,372.2. But notice that this number, $5,372.2, is going to be next period's, which is period number 2's beginning net book value. And you continue like this. One interesting thing that I want to also mention is that if you continue this framework, what you notice here is that the ending amount of premium in period 10 is 0. And ending net book value of this bond is $5,000, which is equal to face value of this bond. In other words, what you see here is if you apply it consistently, ensures that bond premium is eliminated over time by the end of period 10. And then at the end of year 5, period 10, all you need to pay is the coupon bond's face value of $5,000. So this technology ensures that at the end of the 5th year, the amount of bond payable or net book value is just the face value. Let's just highlight that in period number 10, the amount of coupon payment is $250, the amount of interest expense is $201.3, and the amount of premium amortization is $48.7, which we are going to use in the next part of this solution. So what happens at the time of maturity for a premium bond? We are going to decrease cash account on balance sheet by coupon payment, which is bond interest payment. We are going to decrease income statement by bond interest expense, just like what we calculated, beginning net book value times 4%. We are going to decrease the cash account on the balance sheet by face value of this bond. This is maturity now. It's time to pay back this bond. We are going to decrease the bond payable on balance sheet again by face value. And we are going to close the bond premium account. So let's see this in action. So we have done the bond accounting for this premium bond over the last 9 periods. In period number 10, first, we are going to have 2 cash reductions. The first one is $250 of coupon payment, the last coupon. The second one is $5,000, which is the face value payment for this bond. Bond payable is minus $5,000. There is no more bond payable because now we paid. The amount of interest expense is what we have seen in that bond amortization payable is coming from beginning amount of beginning amount of bond payable times 4%. It's going to be $201.3. It's not going to balance. To make it balance, you are going to have $48.7 reduction from bond premium account, which ensures that at the end of period 10, there is no more bond premium. It's all zero. Now let's apply the same framework for a discount bond. Let's please read the question, which is very similar to premium bond. Face value is $5,000. Coupon rate is 10%. Now the market rate is not 8%. It's going to be 12%. Issuance date doesn't change. It is January 2015, and the maturity is again 5 years. Since the market rate is higher than the coupon rate, this is going to be a discount bond. How are we going to price the discount bond? It's exactly the same. We are going to again use our formula. Bond price is equal to sum of present value of future coupon and principal payments. The present value of $5,000 in 10 periods from a 6% market interest rate, which is semi-annual. Notice that annually it is 12, 6% is semi-annual. It's going to be $2,791.97. Again, present value of coupon payments, $250 each over the next 10 periods, discounted at 6%, is going to give you $1,840. If you sum them up, the amount of this, the value of this discount bond at the time of issuance is $4,632, which is much less than $5,000 because this is a discount bond. How are we going to do the accounting at the time of issuance? It is very similar to premium bond. Cash goes up by $4,632. Bond payable is still the same, $5,000, which is the face value of this bond. It's not going to balance. To make it balance, you are going to create another special liability account called bond discount. In this example, it is $368. Since market interest rate is higher than coupon rate, this bond is issued at a discount of $368. Discount bond after issuance, it is exactly similar to what we have seen premium bond. You are going to first record coupon payment, which is bond interest payment. You are going to report bond interest expense, which is calculated with the same technology, beginning amount of bond payable times market interest rate. And then it's not going to balance. To make it balance, now you are going to play around with the bond discount account. So let's just see what happens. June 30, 2015, this is the time to make the first coupon payment for this discount bond. Of course, cash will be reduced by $250. The amount of interest expense will be 6%, which is semi-annual market interest rate, times the beginning amount net book value of this bond, which is going to be how much? $4,632. It's going to give you an interest expense of $277.9. It's not going to balance. To make it balance, you are going to add a positive number to bond discount. It's going to be 27.9. Let's do this one more time. At the end of year 2015, cash reduction will be $250. The amount of interest expense will be how much? It's going to be, what is the new book value of this bond? It is going to be $4,632 plus 27.9 times 6%. It's going to give you a new interest expense of $279.6. It's again not going to balance. Therefore, you are going to add another positive number to bond discount account. Now, this is going to be 29.6. Again, you continue like this. And just like for premium bond, we can come up with an amortization table for a discount bond. I suggest you stop the video here and go through this framework. It is exactly just like what we have seen for the premium bond. We have beginning amount of this bond. Interest expense is 6% of the beginning net book value. Coupon payment is always $250. The difference will be discount amortization. Initial amount of discount is, as we have seen in the previous question, $368. And at the end of the first coupon payment, it's going to be $340.1. It's going to go down, down, down. At the end of period 10, there will be no more discount. And again, at the end of period 10, all of the discount will be removed. The ending amount of this bond will be $5,000, which is going to be face value. What is the discount bond accounting at the time of maturity? Nothing changes. We again pay coupon payment. We again record interest expense. We are going to pay the face value of this bond. And then we are going to close our discount account. So let's see this in action. In December 2019, we are going to make two payments. One, $250 of coupon, last coupon, and second, $5,000 of face value of this bond. Bond payable account is closed. It's minus $5,000. What is the amount of interest expense, which you can see from the previous bond amortization table? Let me just go there. The amount of interest expense in period 10 is 297.2, which I'm going to use here under interest expense in the income statement. It is not going to balance. To make it balance, you are going to have the final bond discount of 47.2. This way, bond discount account will be removed. It was initially a large negative number. Over the next 10 periods, we had small positive numbers, and by the end of period 10, there is no more bond discount accounts. So in other words, discount bond, premium bond, the algebra or the accounting is similar. The only difference here is that in a bond premium, the special account you come up with is bond premium account. In a discount bond, you are going to come up with a bond discount account under liabilities. The next bond that I'm going to introduce you is a very special bond. It's called zero coupon bonds. Zero coupon bonds are a special case of discount bonds. These bonds do not make periodic coupon payments. They pay no coupon at all. That's why the name is zero coupon. All you are going to be paid is at the time of maturity a certain amount of face value. Instead, these bonds make a large sum payment at the time of maturity. Let's see the accounting for zero coupon bonds in action. We have a bond, face value is 5,000. Coupon rate is 0. Why? There is no coupon. Market interest rate is 10%. Issuance date is January 2015. Again, it's a 5 years bond. And we are going to assume that there are semi-annual calculations. Let's just revisit our bond pricing formula. What was it? It was sum of present value of future coupon and principal payments. There is no coupon. Therefore, the bond price will be equal to sum of or only the present value of future principal payments. How are we going to calculate this? $5,000 from 10% annual market rate is going to be 5% semi-annual market rate over the next 10 period will be worth today $3,070. So you don't worry about coupon payments at all. The price of this bond is $3,070. How are we going to do the accounting for this? At the time of issuance, cash will go up by $3,070. Bond payable is still $5,000, and you are going to have a huge bond discount amount of $1,930. As you are going to see soon, the accounting will be very similar to discount bond. So the first coupon date comes, although we are paying no coupon. What's going to happen? The cash reduction for coupon reasons is 0. We don't pay anything. What is the amount of interest expense? Same. It is equal to beginning net book value of this bond, which is going to be $3,070 times 5%. So your interest expense will be $153.5. Okay, it's not going to balance. To make it balance, you are going to add the same amount, $153.5, to bond discount account as a positive number. Let's do this one more time. At the end of year 2015, again, there is no coupon. What is the new amount of interest expense? It's going to be $3,070 plus 153.5. This gives you the beginning amount of net book value of this bond times 5%. Your new interest expense will be 161.2. It's not going to balance. To make it balance, you are going to add this amount, 161.2, the bond discount account as a positive number. And then you continue. So you can come up with another amortization table now for a zero coupon bond. The only fancy thing here as compared to our discount bond is that notice that the coupon payment numbers are always 0. Therefore, your interest expense is always equal to your amortization of the discount. And if you continue with this algebra, you're going to see that by the end of period 10, there is no more discount ending net book value of this bond will be $5,000. So let's just focus on here. The loss interest expense is $237.4. So the accounting for the zero coupon bond at the time of maturity, very similar, except there is no coupon payment. The cash reduction will be $5,000, right? That's how much you are going to pay. That's the face value of this bond. Bond payable account is closed. The amount of interest expense that we have seen in the previous amortization table is $237.4, and it's going to be also your last bond discount amortization, $237.4. Basically, if we continue with this algebra, by the end of period 10, there is no more discount, and then you pay face value to your bond investors. The next issue I'm going to discuss with you is all early bond repurchase. Firms sometimes repurchase their bonds from the market before the maturity date. This may result in a gain or loss. This gain or loss is recorded as a component of continuing operations in our income statement. So how are we going to calculate this gain or loss? We are going to calculate the market value of this bond using the current market interest rates at the time of repurchase. This will be the bond repurchase price. And the gain and loss from the bond repurchase will be equal to current market value of this bond, which is my repurchase price, minus net book value of this bond, which we record on our financial statements. Let's give you an example. This is my discount bond, and here is the accounting after the first coupon payment. Therefore, if you look at here, the net book value of this bond after the first coupon payment will be equal to $4,632 plus $27.9. Let's suppose that at this point we are going to repurchase this bond. And suppose that this discount bond is repurchased from the market when the market interest rate is 11% now. What is the gain or loss from this repurchase? First, we need to calculate the repurchase price of this bond. What is the price of this bond whenever I decide to repurchase this bond? We are going to use the same framework. Bond price is equal to sum of present value of future coupon and principal payments. For this particular bond, what do we have? We have principal payment of $5,000. Market interest rate is now 11%. In other words, 6 months, it is 5.5%. That's going to be my discount rate. Notice that I'm going to discount it just for 9 periods. Why? Because we are deciding to repurchase this bond after the first coupon payment. First coupon payment is gone. There is 9 more coupon periods. The present value of the coupon payments will be $250 times, again 5.5% discount rate. Again, they are discounted for 9 periods. If you sum them up, at the time that I want to decide to repurchase this bond, the bond price will be how much? $4,826. This is the money that I'm supposed to pay to the market to repurchase my bonds after the first coupon payment. So what will be the gain or loss associated with this bond repurchase? Market price is $4,826. Net book value that we have seen in the previous slide is $4,659.9. There will be a loss of $166.1. So how are we going to do the accounting for this? First of all, we are going to repurchase these bonds from $4,826. Therefore, there is a cash reduction. Bond payable is removed. I'm supposed to pay nothing from now on. The bond is repurchased. You close the bond discount account. There is no more bond. Therefore, the bond discount account is meaningless. And you are going to see that the loss that you are going to take out of this transaction is $166.1, which is what we have calculated in the previous slide. In this lesson, I'm going to introduce you leases. A lease is an agreement between a lessor and a lessee where the lessee has the right to use an asset of the lessor for a specific period and a pre-specified periodic payment. In other words, leases is just like rental contracts. Starting with December 2018, most of the leases are capitalized for financial reporting purposes under US GAAP. So what is the lease accounting? Lease accounting at the inception, this is the time that I am initially leasing an asset. We are going to calculate present value of future lease payments. And we are going to recognize this amount as an asset and as a liability. What is the accounting of leases after the inception? Calculate periodic interest expense based on the amount of liability and the discount rate given. And we are going to calculate periodic asset depreciation based on asset's life. Let's give an example. Firm A leases a truck from Firm B for 5 years. Firm A will pay $5,000 at the end of every year for the next 5 years. Assume that the discount rate of Firm A is 10%. Also assume that the truck has a 5 years of life. One very important note here, the lease asset life is independent of lease term. Here we said that the truck will have a 5 years of life, and we also lease this asset for 5 years. They don't have to be the same. It's quite possible that the truck can have 10 years of life, but I just lease it just for 5 years. That's possible. What was the lease accounting at inception? We are going to calculate present value of the future lease payments, and we are going to recognize this amount as an asset and as a liability. So therefore, the present value of future lease payments is $18,954. Let's see how we are going to do the accounting for leases. At the time of inception, we are going to create a lease asset of $18,954. We are going to create a lease payable of $18,954. At the end of first year, now it's the time to pay back first lease payment. But before that, I'm going to record the depreciation expense of the lease asset which we have calculated at the beginning of the year. The amount of this lease asset is $18,954. We assume that the truck has a 5 years of life, and if you use straight line depreciation, the amount of depreciation expense will be $3,791, which is reduced from lease asset, and it's going to be recorded on the income statement as a depreciation expense. Again, at the end of year one, I'm going to also make a lease payment of $5,000. Therefore, there is a cash reduction of $5,000. We are going to record interest expense because we have a liability. What is the size of our liability? $18,954 times our interest or discount rate given in the question as 10%. So our interest expense will be $1,895, and the difference will be reduced from lease payable. $3,105 will be reduced from our lease payables. In year number 2, we are going to do the same thing. But before we go further, over there I have recorded year 1 ending balances. The cash is $5,000 minus. Lease asset is $15,163 because we recorded the first year of depreciation. Lease payable is $15,849 because of the first year's lease payment. And finally, income statement number is $5,686. It comes from depreciation expense and interest expense of last year. In year number 2, we have again the same amount of depreciation expense for our asset. It's going to be $3,791. It's going to be also recorded on the income statement as a depreciation expense. And secondly, we are going to make the second year lease payment of $5,000. Cash goes down by $5,000. Income statement should be recording my interest expense. It's going to be $15,849. That's my lease payable times 10%. And finally, their difference, $3,415, will be reduction from lease payable. And we are going to continue like this until end of year 5. And if you continue like this correctly, you are going to see that the amount of lease assets and lease payable by the end of year 5 will be all 0. Now, let me introduce you how lease accounting and lease disclosures work in real company financial statements. Here we have United Airlines leases disclosures for year 2018. We have capital lease obligations, the amount that we are supposed to pay starting with year 2019. And if you look at the disclosure carefully, we are going to also see that present value of future capital lease obligations is 1,283 in millions. How can we utilize this lease disclosure? One can calculate the discount rate of United Airlines from the lease disclosure footnote, which is just introduced to you. Suppose that the lease payments after 2023 will be equally paid over the next 7 years. Just to make sure that we are on the same page, 7 years is my assumption. You can say 5, somebody else can say 7. As long as the assumption looks reasonable, you are going to come up with a reasonable discount rate for leases. So in this Excel sheet, what do I have? I have the years, 2018, 19, going to 2013. For 2018, I put the current present value of these lease commitments. If you go back to previous page, you're going to see it is 1,283. And then starting with year 2019, I put amount of lease payments that we are supposed to make. For 2019, we pay 308, so on and so forth. What you can do is that you can ask Excel, which makes these future lease payments to be equal to 1,283 today. And that rate is actually called IRR, which stands for internal rate of return. So 9%, which is calculated here by the help of an Excel, tells me that the 9% is the discount rates which make the future lease payments to be equal to today as a present value 1,283. In other words, the lease discount rate for United Airlines is 9%. I suggest you apply this framework for some other public companies. Just open them up, see whether they have any leases. You can use, for example, American Airlines, and see whether you can calculate a reasonable discount rate for American Airlines. Now we are going to cover some cases to see how we can apply what we have learned about liabilities to real-life scenarios. Here is case number 1. Refer the table in Johnson & Johnson's 2010 annual report for long-term liabilities. Recall that the company's fiscal year end is 2 January 2011. And using the information provided, answer the following questions. There is an important noted. We are going to use just semi-annual calculations. So we are going to calculate interest for every 6 months. Question number 1. Refer to the 5.55% debentures due 2017, which is the third instrument on the table. Calculate the interest expense on this note for fiscal year 2011, which is the year ended to January 2012, which is basically our next fiscal year. So let's just look at this note first of all. This is note number 7. Here is the third item here. And what do we see about this note? Well, the first number that we see here is 5.55. What does this mean? 5.55% is the coupon rate associated with this bond. And what do I know about this bond? In year 2009 and in year 2010, its value is 1,000. Its value doesn't change. If the bond's value doesn't change between 2 years, what kind of bond is this? It is a par bond. In fact, we can understand that it's a par bond because if you look at the effective rate, basically it is the interest rate on these bonds. It is 5.552. Interest rate is equal to coupon rate. Therefore, this is a par bond. Since the value of the instrument doesn't change between year 2009 and 10, this is a par bond. For par bonds, interest expense is equal to coupon payment. Therefore, interest expense is 5.55% times 1,000. We are going to find 55.5 in year 2011. There is no need to use 6 months here because the question is explicitly asking you for the next full year. How much is the interest expense? 5.55. Here is part B of this question. Refer to the same note in part A. Provide the entry the company will record at maturity. At the time of maturity, what are we going to do? We are going to make 2 payments. First, we are going to make half of the annual coupon payments. And the coupon payment or the interest expense that we have calculated in the previous questions, 55.5, divided by 2, it's going to give you 27.75. So basically, we are going to first pay this half coupon. Cash goes down by 27.75. And then you also record any interest expense of 27.75 on the income statement. And secondly, you pay the total face value of this bond at the time of maturity. That's going to be $1,000. Cash goes down by $1,000, and bond payable value is decreased by $1,000 because we paid this bond this bond is removed from our liabilities. And here we see that this value 1,000 as the bond face value. Now refer to the 3% zero coupon convertible subordinated debentures due 2020, which is the sixth instrument on the table. Calculate interest expense on this note for fiscal year 2011, which is basically the next year. All right. Before we go further, let's just look at footnote number 7 and what do we know about this bond. This bond had a value of 188 in 2009 and 194 in 2010. And if you look at the effective interest rate, it is about 3%. So how are we going to calculate this zero coupon bonds interest expense for our fiscal year? So I'm going to start with the beginning value of 194, right? So which is the ending value of fiscal year 2010, which is the beginning value of fiscal year 2011. The bond payable is 194. Then what do? We calculate interest expense. What is the interest expense? It is equal to beginning amount of bond payable times our interest rate or effective rates, which is also given in the table as 3%. But note that we are doing our calculations semi-annually. Therefore, I'm going to multiply 194 with 1.5%. And then I'm going to find an interest expense of 2.91. Therefore, it is reducing income statement. And then, do I pay this money? No, this is a zero coupon bond. I'm not doing any coupon payment. Therefore, what's going to happen? This 2.91 will be added to original balance of bond payable. Next, I'm going to do another coupon payment calculation, although I'm not paying any coupon. So first, I'm going to calculate interest expense. Now, what is the interest expense? Now, again, the calculations are similar. It is beginning book value times 1.5%. Beginning book value now this time 194 plus 2.91 times 1.5%. It's going to give you 2.95. That's going to be your interest expense. And from the liabilities, we increase the amount of bond payable by 2.95. There is no coupon payment. If you sum these two numbers, you're going to find that for the next fiscal year, the net amount of interest expense is 5.86 million associated with this bond. Here is question number 2. The following pages contain balance sheet and part of footnote number 10C for Pfizer from their 2007 annual report. Using this information, please answer the following questions. Question number 1 is asking you, what is the net book value of Pfizer's long-term debt at December 2007? To answer this question, I'm going to look at balance sheet. I'm going to look at the liabilities section. I'm going to find the item which is long-term debt, and the value of the long-term debt that you see on the balance sheet is 7,314 in millions. It's coming from the balance sheet liabilities section. The following questions relate to 6.50% senior unsecured notes due December 2018. This is the 7th item on the table. Assume that the face value of these bonds is 700. And then the interest is recorded annually. All right. For this question, interest is annual calculated. What is the estimate? What is your estimate of the amount of interest expense that the Pfizer recognized in fiscal year 2007 on these 6.50% notes? The answer is 66.5. But how do we do this? So let me just show you by using our transaction worksheet. Before we go further, let's just examine this 10.C. And what do we know about these bonds? First of all, we have a line item called 6.50%. What is this? This is the coupon payment. And the value of this bond in 2007 is 527. In 2006 is 506. And the maturity is given as December 2018. So how can I use this information? Well, I'm going to start my journey. What is your estimate of the total amount of interest expense Pfizer recognized in fiscal year 2007, which is this year? Okay, we are in fiscal year 2007. I'm going to start my journey for fiscal year 2007, the beginning balance of this bond payable, which is 506. Look at, please, on the table. It is 2006 value of this bond, which is 506. All right. So what do I know about this bond? This bond has 6.5% coupon rate. Therefore, First, I do the calculation for coupon. And how do I calculate the coupon? It is 6.50% times the face value of this bond, which is given in the question as 700. And if you do the algebra, you're going to find that the coupon payment is 45.5. Okay? And then what else do I know about this bond? This bond's value increases from 506 to 527 in year 2017. Therefore, there is an increase of 21 in the bond payable. That's where it's coming from. So, if you look now, the second line item here, we calculated coupon, we know the increase in bond payable. What is missing here? The thing that is missing here is the amount of interest expense. So, what is the interest expense? It is the value that makes this algebra correct. It's going to be 66.5. That is the amount of interest expense. If you go back to what is the answer of this question, the answer of this question is coupon payment 6.5% times 700 plus 21, which is the increase in notes, which is the increase in bond payable associated with this bond. It's going to be 66.5%. Here is part B of this question. What is the amount of unamortized discount or premium related to 6.50% notes at December 2007? So in this year, what is the amount of premium or discount? Well, this is a discount bond. Why? Because if we just look at this note, the value of this note is going up over time. And what is the amount of discount at the end of year 2007? It's going to be the difference between 700 and 527, which is the latest book value for these notes. It's going to be 173. And part C, what is your best estimate of the historical interest rate on the 6.50% note? Well, to calculate this, I'm going to use how we calculate interest expense formula. Interest expense is equal to interest rate times the beginning net book value of this bond. Well, according to the previous question, we know that in the fiscal year 2007, the amount of interest expense is 66.5. We don't know the interest rate, but we know the beginning amount of this bond in year 2007, which is the 2006 number. It's going to be 506. And if you do the algebra, you are going to find that the interest rate for this bond is 13%. Does it make sense? It does, right? The interest rate is 13. Coupon rate is 6.50. Therefore, this is a discount bond. Part D, what is your best estimate of total amount of interest expense that FISA will record next fiscal year? Well, for next fiscal year, I'm going to still use the same formula. Interest expense is equal to beginning bond payable times interest rate. Interest rate is 13% that we have calculated in question C. We need beginning bond payable for next fiscal year. It's going to be 2007 bond payable number. That's going to be 527. And if you do the algebra, you are going to find 68.51. And finally, what is your best estimate of the fair value of 6.50% notes at December 2018 when they are due? Just before they are due, okay? Just before this bond issuer will pay you 700. What is the value of this bond in the market? It must be 700. And here is question number 3 for our long-term and short-term liabilities section. Refer to the table below from Southwest Airlines 2017 annual report for capital leases. Using the information provided, answer the following questions. Question number 1, what is the present value of future minimum capital lease payments for Southwest Airlines? I'm going to look at these notes. There is a section called capital leases, and here I'm going to look at line item present value of minimum lease payments. It's going to be 780, which is explicitly given in the notes. Here is question number 2. Suppose that the lease payments after 2022 will be equally paid over the next 5 years. So what is this question talking about? So for after 2022, there is a line item called thereafter, and the value of this thereafter is 416. The question is telling me that this 416 will be paid equally over the next 5 years. And accordingly, can you calculate the lease discount rate for Southwest Airlines? Well, what I have done here is that I come up with an Excel sheet. For every year, I recorded how much we pay for these capital leases. Notice that starting with 2023, the amount of payment is 83 because the question is telling me that 416 will be paid over the next 5 years. 416 divided by 5 is 83. And then and I also know the present value, which is 780. I can use the IRR formula of the Excel, and I can find that the amount of discount rate associated with this lease is how much? 3.5%. Third question here is, what is the journal entry for capital lease payments for fiscal year 2018, which is the next year? All right, so I'm going to start the beginning balance of our lease payables. How much is it? 780. For next year, what is the amount of payment that I'm supposed to make for this capital lease? 107. That is explicitly given in the note. What is my interest expense? Interest expense is always equal to beginning amount of lease or note payable times our interest rate that we have just calculated as 3.5%. So 3.5% times 780 is going to give you 27.3. It doesn't balance. To make it balance, you need to reduce the value of the lease payable by how much? 79.7. So this is going to be the journal entry associated with capital lease payment next year. Now I will go to fourth case in liabilities. Refer to the table in Amgen's 2006 annual report for long-term liabilities. Recall that the company's fiscal year end is December 2006. Using the information provided, we are going to answer the following questions. Again, the question tells us that we got to use semi-annual calculations. Question number 1, refer to the 4.85 notes due 2014, which is the first instrument on the table. Calculate the interest expense on this note for fiscal year 2007, which is year ended December 2007. So let's just look at the note about what do we know about this note. So it is 4.85% notes due 2014. Between year 2005 and 6, the value of these notes doesn't change. It's always 1,000. Therefore, this is again a par bond. Since the value of the instrument doesn't change between year 2005 and 6, this is a par bond. For par bonds, the interest expense is equal to coupon payment. What is the coupon payment? It's going to be 4.85%, which is given in the question, times 1,000. It's going to give you 48.5 in year 2007. Refer to the same note in part A. Provide the entry that the company will record at maturity. At the time of maturity, we are going to have two payments. One, half of the annual coupon payment, and second, we are going to pay the maturity. What is going to be the half of the coupon payment? So as we have calculated in the previous question, annual coupon payment and interest expense is 48.5. If you divide this into two, you're going to find that half of the coupon payment is 24.25. Therefore, there will be a cash decrease of 24.25. And then it's going to be recorded under income statement as an interest expense. Second, we are going to pay the face value of this bond, which you can see here. It's going to be 1,000. If you pay the face value, cash will go down by 1,000, and bond payable will also go down by 1,000. And here is part C of this question. Refer to the zero coupon notes due 2032. Assume these notes have an annual yield of 1.125%. This is the interest rate or the discount rate for these notes, 1.125%. Calculate the interest expense on this note for fiscal year 2007. So what do we know about these bonds? This is the third item in the note. Its value in year 2005 is 1,759. Its value in year 2006 is 1,778. It's a zero coupon bond, and then it's due to mature in 2032. So can we do the algebra for interest expense calculations for these notes for year 2007? Yep. I'm going to start with the beginning balance of this bond, which is 1,778. All right. And then I'm going to calculate the first coupon payment. Although we are not paying coupon, there will be interest expense. Therefore, we are going to calculate the first coupon payment. How much is the interest expense? Interest expense is equal to beginning amount of bond payable, 1,778 times 1.125%. That's annual discount rate or the interest rate, divided by 2. It's going to give you 10. So from the income statement, there is an interest expense of 10, and then we don't have any coupon payment. Therefore, cash is not impacted at all. This 10 is added to bond payable. Next, for the next 6 months. I'm going to calculate this, do the same calculation again. But now what is the beginning amount of bond payable? It is going to be 1,778 plus 10 times our interest rate, which is 1.125%, divided by 2. It's going to give us 10.1. And then 10.1 will be also added to bond payable. Therefore, for year 2007, which is the next fiscal year, the amount of interest expense associated with the zero coupon bond is how much? 20.1. And here is question number 5. The following pages contain the balance sheet and part of the footnote 18 for Tyco from the 2002 annual report. Use this information and please answer the following question. Question number 1. What is the net book value of Tyco's long-term debt at December 2002? In order to answer this question, I'm going to look at the balance sheet. I'm going to look at the liabilities section. Under this section, there's a line item called long-term debt. Its value is 16,486.8. Question number 2. The following questions relate to zero coupon convertible senior debentures with 2003 put options, which is the 12th instrument on the table. Assume that the face value of this bond is 4,000 and then the interest is recorded annually. The first question is asking you, what is your estimate of the total amount of interest expense that Tyco recognized in fiscal year 2002, which is this year? So in order to tackle this question, first let's examine what does this zero coupon note look like. This is footnote about debts. There is this line item called zero coupon convertible debentures, etc. Its value in year 2001 is 3,499. Its value in year 2002 is 3,519. So in order to tackle this question, I'm going to use this beginning and ending values. And then I'm going to calculate interest expense for year 2002. The beginning amount of this bond is how much? 3,499.4. Ending number is 3,519.1. So note that the value of this bond is increasing by how much? 19.7. All right, if you want to do the algebra, the bond payable goes up by 19.7. There is no change in cash because this is a zero coupon note. Therefore, it must be the case that the amount of interest expense recognized in year 2002 is how much? Again, 19.7, which is the net increase in bond payable. What is your best estimate of the historical interest rate on the zero coupon debentures? According to our course area lectures, what did we learn? Interest expense is equal to interest rate times beginning bond payable. All right, so interest expense that we have just calculated is 19.7. Interest rate we don't know. The beginning amount of bond payable for year 2002, the beginning amount of bond payable is year 2001 values, 3,499.4. And if you do the algebra, you're going to find that the amount of interest rate for the zero coupon bond is how much? 0.6%. Part C. What is your best estimate of the total amount of interest expense that Tyco will recognize next year? Well, it's the same thing. For next year, what is the beginning amount of bond payable? It is this year's bond payable. It's going to be 3,519.1 times the interest rate that we have just calculated, 0.6%. You're going to find that the next year's interest expense, our estimate is 21.1. What is your best estimate of the fair value of the zero coupon notes at December 2020 when they are due? Just before they are due, okay? So the company is about to give you the face value of these bonds. If you look at the market price of this bond, how much should it be? It's going to be 4,000, which is same as face value. And here is the third question here. Assume that the 4.95 notes due 2003, which is the 10 instrument on the table, were originally issued at a par. What must have happened during year 2002? All right, let's just look at these notes. What do we see about these notes? In year 2001, its value is 598. In year 2002, its value is 561. If it is a par bond, its value shouldn't change. It should be still 598, but there is a decrease in the value of this bond. So what must have happened? Since the net book value went down, Tyco must have paid off a portion of these costs and these notes. Therefore, there is a decrease in these liabilities. And here is case number 6. Refer to the table from Marriott International's 2018 annual report for capital leases. Using the information provided, answer the following questions. Question number 1, what is the present value of future minimum capital lease payments for Marriott? The answer is 163. Where do we find this? Well, here is the note. You look at the capital lease column, and there is the last item here is called present value of minimum lease payments. It's going to be 163. For the sake of this question, please ignore operating leases. As we mentioned in the Coursera lectures, operating leases are there, but they are going to be we will no longer be able to use operating leases. Question number 2. Suppose that the lease payments after 2023 will be equally paid over the next 5 years. Calculate the lease discount for Marriott. Well, let's just look at these notes one more time. After 2023, the amount of capital lease payments here seems like 165. The question is telling me that we are going to pay these amounts equally over the next 5 years. So if you put an Excel sheet, the present value is 163. I have the payments for year 2019, 20, and then starting with year 2024, the amount of lease payments for capital leases is how much? 33. And if you use the IRR formula of the Excel, you are going to find that the discount rate is how much? 5.54%. And what is the journal entry for capital lease payment in next fiscal year, which is 2019? Well, I'm going to start my journey with the present value of these leases, 163. For next year, how much is the payment associated with capital lease? It's going to be 13. Let's just see the 13. Okay. And what is the amount of interest expense? It is beginning amount of lease payable, 163, times the discount rate that we have just calculated, which is about to be 5.54%. Therefore, the amount of interest expense is 9. And so we know the amount of payment. We know the amount of interest expense. It doesn't balance. To make it balance, the reduction from the lease payable should be 4. And this concludes my discussion of cases for liabilities. Hello, welcome to Financial Accounting Advanced Topics here at University of Illinois. Today, we are going to learn about shareholders' equity. In particular, we will go through accounting for equity issuance, dividends, treasury stock, and earnings per share calculations. So what is shareholders' equity? According to fundamental accounting equation, assets are equal to liabilities plus shareholders' equity. Therefore, shareholders' equity is equal to assets minus liabilities. In other words, shareholders' equity is the amount of total assets financed by firm's owners. We call these owners as shareholders. Shareholders do have voting rights. Therefore, they have a huge impact on firms' financing, operating, and investment policies in the future. Let me tell you a very important detail here. There could be many transactions between shareholders and firms, but these transactions will never ever result in any profit or loss. One more time, the transactions between firms and shareholders do not result in any profit or loss, and this is a very important detail to keep in mind. So how does shareholders' equity look like in practice? Here is shareholders' equity of Walmart at the end of year 2015. So according to this slide, it looks like at the end of year 2015, the total amount of shareholders' equity for Walmart is $85,937. So where is this number coming from? So some of the important accounts under shareholders' equity are common stock, capital in excess of par value, and retained earnings. Now we are going to spend some more time about these specific accounts recorded under shareholders' equity. There are mainly three reasons why shareholders' equity could change within a year. These are equity issuance, profitability, and distributions. Now we are going to spend some more time about these three factors. Let's start with equity issuance. Under equity issuance, firms issue common shares to shareholders. Shareholders purchase common shares and therefore they also get voting rights. And because of these voting rights, they can impact the firm's operating, financing, and investment policies in the future. When shareholders purchase common shares, they get share certificates. If you look at share certificates, most of the time, there is a very small value written on that share certificate. This small value is called par value. Par value is not an accounting concept, it's a legal concept. It is the small value written on each share certificate. Most of the time, it's a value of about like 1 cent or 10 cents. It's a very, very small number. But when shareholders were purchasing common shares, they pay much more than par value. And the difference between how much is paid by shareholders versus how much is par value is called additional paid-in capital. For example, if we are talking about a common share which has a par value of $1 but sold in the market for $5, that additional $4 will be recorded as additional paid-in capital. Another interesting terminology under shareholder issuance is authorized shares. Authorized share is the maximum number of shares that can be printed by a firm. In other words, if a firm wants to print more shares than authorized number of shares, it needs to change its articles of incorporation. Again, it is a legal concept. The second term here, very interesting, is issued shares. Issued shares is the number of actual printed shares by the firm, and necessarily it is a number less than authorized number of shares. And the third concept here is outstanding shares. Outstanding shares means number of shares actively traded in the market. And it can be a number which is different than issued number of shares. Why? Because it's possible that sometimes firms issue shares, but after some time, they go ahead and repurchase some of these shares back. We call these repurchased shares as treasury stock. And the difference between issued number of shares and the treasury stock is called outstanding number of shares actively traded in the market. Soon, we are going to spend some more time about treasury stock. So what is the accounting for share issuance? And here is a small example. We have 5 friends establishing a firm by putting down $5,000 each. In return, firm issues 10,000 shares and each of these shares has a par value of $1. In terms of accounting, obviously the firm gets 5 times $5,000. This is $25,000 increase under cash column. In return, firm issues 10,000 shares. Each of these shares has a par value of $1. Therefore, 10,000 times 1 will be recorded under common stock account. Common stock account keeps track of par value of printed number of shares. And the difference between 25,000 and 10,000 will be recorded as additional paid-in capital. So let's see these concepts in action. This is shareholders' equity of Walmart at the end of year 2015. If you look at this slide carefully, you will see that the amount of common stock at the end of year 2015 is 323. So where is this number coming from? If you look at notes to financial statements, Walmart says that it has number of issued shares of 3,228 in millions. Walmart also discloses that each of these shares has a par value of 10 cents. So basically 10 cents times 3,228 will give you 323 that you see on this slide. In addition, Walmart says that the capital in excess of par value, which is same as additional paid-in capital, is equal to 2,462. So basically Walmart's shareholders paid 2,462 over and above par value to acquire Walmart shares. The second reason why firms' shareholders' equity could change within a year is profitability. And the profitability changes will be tracked under retained earnings account within shareholders' equity. At the end of year 2015, the amount of retained earnings For Walmart is 85,777. So where is this number coming from? Let's just do a very small exercise. There is a firm providing a service and earns $500 in November 2016, which is payable in April 2017. How do we do the accounting for this? First of all, firm provides a service and therefore earns $500. And because of this reason, under income statement, we have a revenue of $500. But this money is not paid by the customers yet. Therefore, we also record this as account receivable, AR. We come at the end of the year and we do something very important at the end of the year, which is the transferring the balance from income statement to retained earnings. How do we do this? Well, the balance at the end of the year under income statement is $500. We close this account by putting a negative $500. And then we also record this $500 as an increase under retained earnings. So basically, the retained earnings that you see on Walmart's shareholders equity section is coming from this type of transactions. Over many years, Walmart has earned $85,777 for its shareholders. The third reason why shareholders' equity could change within a year is distributions. There are mainly two types of distributions that firms can make. The first one is dividends. Under dividends, firms distribute the same amount of cash to each common shares. And the second way distributions can work is stock repurchases. Under stock repurchases, firms go ahead to the stock market and repurchase some of their own shares back. So let's see how we are going to do the accounting for this type of distributions. Let's start with dividends. And here's a small example. We have a firm with 10,000 shares outstanding, declares and pays $1 per share as dividends. In terms of accounting, there is a reduction of $10,000, which is 10,000 shares times $1 each as a dividends. There is a $10,000 decrease in cash. And at the same time, there will be $10,000 decrease from retained earnings. The important detail here is dividends are paid from retained earnings. Does this make sense? It does make sense. If you remember from the previous slides, retained earnings is the total amount of profits earned by firms but not distributed to shareholders. When these profits are distributed to shareholders, it is normal that there should be a reduction in retained earnings. Here is an example about share repurchases. We have a firm repurchasing 100 shares from the stock market by paying $1,500 in total. How do we do the accounting for this? Well, notice that first of all, we are paying $1,500. Therefore, there is a cash reduction of $1,500. But at the same time, we create a very special account under shareholders' equity. And this account is called treasury stock. Treasury stock has a negative balance. It is recorded under shareholders' equity. And it's an account used to record repurchased shares. So the question here is, why are we repurchasing some of these shares? Well, there are many reasons. The first one is, firm is kind of signaling that, look, we have lots of money. We can do a lot of other things, but instead, we trust our firm. And to show our trust, we are repurchasing some of our shares back. So in other words, firm is giving confidence to the market participants. And because of this confidence, it's possible that stock market price of shares can go up. Second reason is, repurchased shares are not counted within outstanding number of shares. An outstanding number of shares is an important number that we are going to see in the next lesson when we are calculating earnings per shares. So basically, by repurchasing shares, firms can reduce outstanding number of shares and can increase earnings per share. And as I said, we are going to see an example about this soon. And the third reason is that repurchased shares can be used by firms as a compensation to employees. It's a big hassle in terms of legal fees, etc., to print shares. Instead of printing shares, firms can just go ahead and easily repurchase shares from the market and distribute to employees as a form of compensation. The last thing that we are going to learn today is earnings per share calculations. Earnings per share is a very important number used by capital market participants to judge firms' profitability. It is calculated as net income divided by number of shares outstanding. Here's a small example. For my firm, the amount of net income is 150,000. The number of outstanding shares is 25,000. Therefore, 150 divided by 25,000 will give you $6 per share as a earnings per share. As we were mentioning in the previous lesson, outstanding number of shares can be manipulated by repurchasing some shares as treasury stock. So it's quite possible that firms can repurchase some of these shares just before this calculation is made. Therefore, they can have a lower amount of outstanding number of shares, and therefore they can increase earnings per share numbers. Here is a brief summary of what we have done today. Today we talked about shareholders' equity. In particular, we went through accounting for equity issuance, dividends, share repurchases, and earnings per share calculations. In the next module, we will go through cash flow statement. Until that time, take care. In this video, I am going to introduce you some advanced issues in shareholders' equity accounting. First, let me start with preferred stocks. Preferred stocks are just like common stocks issued by firms and that can exist in the company's shareholders' equity. Preferred stocks may have the following features and thus differ from the common stocks. How about dividends? They have a guaranteed pre-specified amount of dividends, usually larger than common share dividends. Preferred stocks can be convertible. They can be converted to common shares at a pre-specified rate. Preferred stocks can be cumulative. Unpaid dividends accumulate and must be paid before common shareholders. Preferred stocks can be callable, can be retired by management anytime at a pre-specified price. Preferred stocks can be redeemable. So redeemability is something similar to being callable. Finally, preferred stocks can be participating. Preferred stocks can be entitled to additional dividends based on some predetermined condition. For example, when common share dividends are larger than preferred share dividends, preferred shareholders will get extra dividends. In general, preferred stocks do not have voting rights, but they might have some other special rights. The second advanced issue under shareholders' equity is secondary market trading. Firms issue and sell their shares to the public in primary capital markets through IPO, which stands for Initial Public Offering, and SCO, it means Secondary Equity Offerings. Primary market activity is relevant for accounting through accounting for shares issuance. When firms print shares and issue them to the public, we record them under shareholders' equity accounting. Investors, after the shares are issued, investors trade shares in the secondary capital markets in stock exchanges, for example, New York Stock Exchange. Investor trading in the secondary market is not relevant for accounting. In other words, share price changes and name of the shareholders are not accounted for. It's quite possible that we issue a share to the market, for example, $10, now it is $100. We don't care. Next, I'm going to discuss with you some special type of equity issuances. First, open market issue, issuance of shares for all capital market participants. They are subject to existing shareholder preemption rights. Basically, if we have an existing shareholder, and if this shareholder owns 10% of my firm, he or she has the rights to still keep the 10% of this firm in open market issues. I'm going to ask this person first whether they want to buy some more shares so that their amount of ownership, which is 10%, doesn't change. But after that, I can sell these shares anybody I want. Rights issue, issues of shares to only existing shareholders, usually for a cheaper price. So this is quite very interesting. I'm not selling these shares for everybody. I'm selling it only to my shareholders. Generally, I sell it cheaper. It doesn't matter they are cheaper or more expensive. Remember, from the shareholders' equity accounting, we do not make any gains or losses. The third type of equity issuance I'm going to discuss with you is stock dividends, issuance of new shares to existing shareholders instead of paying them cash dividends. The fourth equity issuance here is stock split, issuance of lower par value new shares in exchange for current shares. So I'm going to take the current shares of the shareholders. I'm going to split into 2, 3, 4. Basically, par value will be also split into 2, 3, 4, and I'm going to give it back to my shareholders. Now, after the stock split, my shareholders will have more shares in their own hands. Finally, the bonus issue means issuance of shares to existing shareholders with no cash consideration. In other words, bonus issue means I am going to print shares as a firm, give my shareholders free. So what is the accounting for this special type of equity issuance? Open market issue and rights issue are accounted for just like how we have learned in the previous videos. So cash will go up, common stock will go up, and the difference will be recorded as an additional paid-in capital. There will be no accounting for stock splits. In a stock split, what's going to happen is that, let's say it's in a 2-for-1 stock split. I'm going to take one share of my shareholders. I'm going to split into 2, and the par value will also be split into 2 and give it to my shareholders. So my shareholders will have now, instead of one share, will have 2 shares with 50% par value in their own hands. From an accounting perspective, nothing changes. Common stock value is still the same. There are going to be more shares, but with less par value. That's all it changes. In a stock dividend, common stock and additional paid-in capital will increase and retained earnings will decrease. In a bonus issue, common stock increases, additional paid-in capital decreases by the same amount. So let me do a couple of exercises about stock dividends and bonus issue. Here is an example for stock dividends. A firm issues 1,000 new shares with par value of $1 to give investors as stock dividends at a time when the stock price is $20 per share. So what is the accounting for this? In the shareholders' equity side, first let's worry about common stock, which records the par value. Par value is $1 each. I print 1,000 shares, therefore common stock will go up by 1,000. The value of these shares currently in the market is how much? $20. I am giving 1,000 shares to my investors instead of dividends. Therefore, the amount of retained earnings reduction will be $20,000. $20 times 1,000. Why there is a reduction from retained earnings? Remember, this is just like dividend payment. Whenever you pay dividends, there will be a reduction from retained earnings. And since instead of paying them cash dividends, I'm giving them shares, there will be again a similar reduction from retained earnings. It's going to be $20,000. It's not going to balance. To make it balance, additional paid-in capital will go up by $19,000. What you see here is that in a stock dividends, we print shares, we give to our shareholders. Instead of cash reduction, there will be increase in common stock and additional paid-in capital. And here is the example for bonus issue. A firm issues 1,000 new shares with par value of $2 each and give them to existing shareholders free. What is the accounting? Of course, there will be increase in common stock. We print 1,000 shares. Each of these shares has a par value of 2. Common stock will go up by 2,000. So you need a negative number. That negative number will be additional paid-in capital decrease of $2,000. So in a case of bonus issue, to make it balance, you reduce additional paid-in capital by 2,000. It's not dividends. Therefore, I'm not going to touch the retained earnings. Another special issue that I'm going to discuss with you under shareholders' equity is share retirement. Sometimes firms repurchase their own shares and cancel them instead of keeping them as treasury stock. Share retirement reduces the amount of shareholders' equity just like treasury stock. Here's an example. A firm repurchases and retires 1,000 shares for $25,000. These shares have par value of $1 each and originally sold to investors from $20 per share. First, I recorded at the time that these shares are issued, what will be the accounting? Well, at the time that they are issued, we issue them to the public from $20 each. There are 1,000 shares printed, cash cash did go up by 20,000. Common stock did go up by 1,000, and the rest is going to be additionally paid in capital of 19,000. When these shares are retired, what will be the accounting? First, in order to retire these shares, we pay $25,000. Therefore, there is a cash reduction of 25,000. Since now you retire these shares, you get rid of common stock and additional paid in capital associated with these shares. Therefore, common stock 1,000 is negative. Okay, I get rid of the common stock of these retired shares. There is a $19,000 deduction from additional paid in capital. So additional paid in capital associated with the shares are removed. It's not going to balance. To make it balance, you are going to record a reduction from retained earnings of $5,000. So you are going to assume this as if I paid my investors $5,000 dividends. Let's do this exercise one more time. The first part is the same. A firm repurchased and retired 1,000 shares, now from 15,000. In the previous question, it was 25. Now it is 15. These shares, again, originally issued from $20 each. If you look at the accounting, the first line is the same. Share issuance cash is $20,000 increase. Common stock increased by 1,000. Additional paid in capital increased by 19,000. When we retire this share, what's going to happen? The share retirement row, if you look at the cash decrease, it's going to be 15,000. You get rid of the common stock and additional paid in capital of these retired shares, and you have 5,000 extra in your hand. What are you going to do? You are going to create a new additional paid in capital account, which I'm going to call it as additional paid in capital of retirement. It's going to be $5,000. So what did we learn? If we have a loss, we are going to record this as a reduction from retained earnings. If we have a gain, just like this example, we are going to record this as a new additional paid in capital. Additional paid in capital means the amount of money given to my firm by my shareholders free. So it looks like that over this share issuance and share retirement, these shareholders gave the firm $5,000 free. Next, I'm going to discuss with you treasury stock reissuance. Firms can reissue previously acquired treasury stocks to the capital markets at a price different than the treasury stock repurchase price. If there are treasury stocks purchased at different times, firms sell first repurchase shares first. That's the assumption. So you are going to use FIFO method to resell treasury stocks from the firm to the capital market participants. Let's do an example. A firm repurchases 1,000 shares for $25,000. Half of these shares are reissued from $20,000, and the rest is reissued from $10,000 at later dates. So what will be the accounting for treasury stock purchase? Cash reduces by $25,000, and then you create a treasury stock account under shareholders' equity as $25,000. At the time of first reissuance, what do? We are going to sell the shares, half of them, from $20,000. Therefore, cash goes up by $20,000. Half of the treasury stock is removed. $12,500 is removed from treasury stock. It looks like that we are making a gain. This gain will be recorded as, just like previous question, my investors are giving me free money. It's going to be recorded as additional paid in capital now coming out of treasury stock of $7,500. So what are we going to do about the second reissuance of this treasury stock? The question says that the rest is reissued from $10,000. Therefore, cash goes up by $10,000. Treasury stock account is removed because all of the treasury stock is sold. There will be basically $12,500 addition to treasury stock. And it looks like that in this second reissuance, we make a loss of $2,500. What am I going to do with this loss? Since from a prior treasury stock reissuance, I have an extra gain of $7,500, this $2,500 loss will be absorbed by this gain. $2,500 will be reduced from additional paid in capital of treasury stock. One important note here, if we sell our treasury stock, if we make a loss, but there is no additional paid in capital of treasury stock, just like in this question, that loss will be reduced from retained earnings. It's just like I'm paying my investors free money, like dividends. In this question, we have an additional paid in capital of treasury stock. Therefore, we use that $7,500 to absorb the loss of $2,500. If there was no additional paid in capital treasury stock, we are going to use retained earnings to absorb this loss of 2,500. The next special issue that I'm going to discuss with you under shareholders' equity is other comprehensive income. Some special changes in value do not affect income statement and net income, but affect a special shareholders' equity account called other comprehensive income. In short, it is OCI. OCI includes what? It includes gains and losses coming from foreign currency translations, special derivative instruments, available for sale securities, and some pensions. These are very advanced topics, therefore I'm not going to go very much into detail. Just as an example, let me give you an example for foreign currency translation. Suppose that we are a US firm and we have a subsidiary in United Kingdom which uses British pounds. In US we use US dollars. Suppose in United Kingdom we have a truck which was originally purchased as, let's say, 10,000 pounds, and originally I converted this into US dollars from $15,000. Let's say next year, because of the exchange rate differences between British pound and US dollar, now the value of this truck shows at not $15,000 but $18,000, let's say. It looks like that the value of this truck appreciated. But notice that this is not a real appreciation. It is still the same truck. I'm not selling this truck. It's just because of exchange rate fluctuations, it looks like there is an increase in the value of this truck. I'm going to use OCI, other comprehensive income, to capture this increase in the value of this truck due to these exchange rate differences. I'm not going to put this in the income statement. This is not a real income. This is not a real gain. It's just coming out of exchange rate differences. I can include this gain on loss of selling this truck only at the time of sale. If I am not selling it because of exchange rate differences, I'm not going to touch my net income. If there is a change in the value, I'm going to use OCI to capture this change in value. Next, I'm going to discuss with you diluted EPS. What was EPS that we have seen in the previous videos? Is equal to earnings per share is equal to net income divided by number of common shares outstanding. This is the definition of basic EPS and ignores the dilutive effect of special financial instruments, including convertible debt and convertible preferred stock. These are debt and preferred stock that can be converted into stock at the request of my bondholder or my preferred shareholder. In the presence of these special financial instruments, which can increase the number of shares outstanding, a more appropriate definition of EPS is diluted EPS. So what is diluted EPS? It is net income adjusted for the effects of dilutive securities divided by number of shares outstanding plus number of dilutive shares. Let's give an example. Illini Corp has the following capital structure. It has 100,000 shares, common shares, 5,000 preferred shares which are convertible, and $750,000 of convertible bonds. 10% is the convertible bonds annual interest rate. During 2015, Illini Corp paid dividends of $1 per share on its common stock and $3 per share on its preferred stock. The preferred stock is convertible into 15,000 common stock. So that 5,000 preferred stock can be convertible into 15,000 common stock. And the bonds are convertible into 20,000 shares of common stock. Net income for year 2015 is $250,000 and the company tax rate is 30%. Let's calculate first basic EPS and then the diluted EPS. Let me start with the first column, basic EPS, which can be calculated as common shares outstanding. In this question at the moment it is 100,000 divided by net income. But here we have a very special instrument which is preferred dividends. Therefore, when you are calculating net income, you are not using net income by itself. You are using net income minus the amount of dividends that I'm going to pay to these preferred shareholders. Remember, you got to pay this money. Therefore, 5,000 times 3 is going to be 15,000 preferred dividends. And after I adjusted my net income with the preferred dividends, total income for EPS calculation will be 235,000, and 235,000 divided by 100,000 common stock will give you basic EPS of $2.35. How about diluted EPS? under diluted EPS calculation, you assume that all the convertible instruments that can be converted into shares are converted. Therefore, I have no more convertible preferred stock. I have no more convertible bonds. They are all converted. Therefore, the new amount of shares under diluted EPS becomes what? The original common shares outstanding of 100,000. Conversion of preferred stock, which is going to bring extra 15,000, and conversion of convertible bonds is going to give you 20,000 extra shares. So under diluted EPS, the number of common shares that you're going to use as a denominator is 135,000. Again, diluted EPS assumption is everything that can be converted into common shares are converted. Therefore, how am I going to calculate the numerator of this diluted EPS? Net income is still 250,000, but I'm not going to pay any preferred dividends because I assume that all the preferred dividends are converted into common shares. Therefore, preferred dividends will not reduce my net income. And then another thing that I assume is that all the convertible bonds are converted into shares. Therefore, you are not supposed to pay any interest associated with this convertible bond. So what do I know about the interest of this convertible bond? The amount is 750,000. It's 10% convertible bonds. Therefore, annual interest rate is how much? 750,000 times 10% is going to give you 75,000. And then, normally, this 75,000 interest expense reduces your tax payable. So after you take into tax effects, 75,000 times 70%, which is 1 minus your tax rate, is going to be in addition to your net income of how much? 52,500. And therefore, total income for EPS calculation will be 302,500. And finally, diluted EPS number is 302,500 divided by your number of shares for EPS calculation of 135,000. You are going to find $2.24. If you look at income statements, most of the time you are going to see both of these numbers. Basic EPS, this is the EPS number we calculate normally, and diluted EPS, which assumes that all the convertible instruments are converted into shares. Now we will go through some cases to see how we can apply what we have learned in this module. Here is case number 1. Yahoo Incorporated report the following summarized balance sheet at December 2017. So according to this simplified balance sheet, we have some assets, some liabilities, some stockholders' equity. Let me please underline that under stockholders' equity, common stock value is 100,000. The par value of each common stock is 1. It must be the case that we have 100,000 so far common stock, and there is no treasury stock. In next year, which is during 2018, the company completed the following transactions that affect stockholders' equity. And we have 5 transactions here. Let's just go through them one by one. Issued 65,000 shares of common stock for $62 per share. Reacquired 6,000 shares of common stock as treasury stock, paying $65 per share. Declared a cash dividend of $2 per common share. In July 1st, we are going to pay these cash dividends, and finally in October, we are going to sell 3,000 shares of treasury stock for $70 per share. Let's just record these numbers on our transaction worksheet. I'm going to start with my issue of common shares. What was the first item here? Issued for 65,000 shares of common stock from $62 each. Therefore, the cash goes up by $4,030,000. Common stock goes up by 65,000. Why? Because we issue 65,000 shares. Each of these shares has a par value of 1. And therefore, the rest should be recorded under additional paid in capital. And that value needs to be $3,965,000. The second item is we are going to reacquire 6,000 shares as a treasury stock by paying $65 each. Therefore, the cash reduction from will be $390,000. That's going to be 6,000 shares times 65 each. and then we are going to record these reacquired shares under treasury stock as 390,000. The third item here is dividend declaration. We are going to declare a dividend of $2 per share, but the thing is, how many shares do we have so far? So if you just do the algebra so far, how many shares we have outstanding? We have 100,000 shares originally. We issued 65,000 shares according to item number 1 here, but we reacquired 6,000 shares which do not require any dividends. Therefore, the amount of net shares or outstanding shares in the market is how much? 159,000 times 2 is going to give you 318, which is going to be reduced from retained earnings because we are paying dividends from retained earnings. And then since we are not paying these dividends, they are going to be recorded under dividends payable. And then next we are going to pay these dividends, therefore dividend payable is removed, and then the reduction from cash will be 318. And finally, we are going to sell half of, because we originally purchased 6,000 shares, we are going to sell half of the treasury stocks from $70 each. Therefore, the cash increase will be 210. What will be a reduction from treasury stock? Reduction from treasury stock is a loose term. Treasury stock is always a negative number. Reduction means you're adding a positive number. It's going to be 195,000. Why? Because you are selling half of these shares. You originally purchased all of these shares for 390. If you sell half of them, the reduction from treasury stock will be 195. It's not going to balance. Okay, you're making money. Why? Because you acquired these shares from 65. You are selling them for 70. For each share, you are making $5. So if you make money from your shareholders, what do we do about these transactions? We are going to record them under additional paid in capital, and the increase in the additional paid in capital will be 15,000. And part B of this question is asking you, what is the stockholders' equity at December 2018, which is next year? Net income for year 2018 was 700,000. Common stock will be summation of 100,000, which is the original value, plus 65,000 new printed shares. Paid in capital will be 5.5 million. That's how we started our journey. Paid in capital increased by 3,965,000, which was we issued shares. And then paid in capital increased 15,000 more, which is the profit that we make from this treasury stock sales. Retained earnings originally was 3 million. There is a reduction of 318 because of dividend payment. And then there is an increase of 700, which is the year 2018 income. Treasury stock originally was 0. We recorded a negative number 390. Basically, the treasury stock value increased by 390. We sold half of these shares. Therefore, treasury stock decreased by 195. We ended up by minus 195,000 for treasury stock. And if you sum all these numbers, you're going to find that at the end of year 2018, the amount of my shareholders' equity is 12,832,000. Here is my second case. The following pages contain the consolidated statement of equity for Chevron from their 2018 annual report. Using the information below, please answer the following questions. Question number 1. What was the number of common shares outstanding at the end of year 2018? That number will be 1,902,838. Where do we find this number? If you look at the Chevron statement of shareholders' equity, the second part, this title here is common stock shares activity. If you look at the last column here, it says outstanding shares at the end of year 2018. That number is 1,902,838. Second question, how many shares of common stock did Chevron repurchase in year 2018? That number is 14,912. Where did I find this information? Again, I looked at this statement of stockholders' equity. Look at the middle column here. It's named Treasury. And then purchases of Treasury in the current year is how much? 14,912. So for year 2018, the amount of Treasury stocks that we purchased is how much? 14,912. What was the average price per share Chevron paid for shares it repurchased in 2018? It is going to be the division of 1,751 divided by the number of treasury stock that we purchased. In millions, it is 14.912 million. So where did I get this first number? How much money I spent when I'm buying this treasury stocks? If you again go to statement of stockholders' equity, there is a line item here called purchases of treasury stocks. What is the effect of this line item? Purchase of treasury stocks increase the value of treasury stock. Again, treasury stock increase means it's becoming much more negative. And if you read this number, it's gonna be how much? 1,751. In the previous question, we have calculated that in millions. The amount of shares we repurchase is 14.912 million. And if you do the algebra, you are going to find that for each of these reacquired shares, we are paying 117.42 to acquire them from the market. How many shares did Chevron reissue in year 2018? That number is 13,048. Where do I find this number? Again, I'm going to look at statement of stockholders' equity. There is this middle column number called treasury stock. And if you look at the line item, how is it called? Issuances. Right? Under treasury stock, you issue these numbers. Then what is this number? 13,048. So this many of shares are reissued, resold to the capital market participants. So here is a tricky question. What was the average price Chevron received from reissuing these shares in year 2018? So we already know the denominator of this question, right? We reissue 13.048 million shares. The question is how much money we generated when we are selling these shares. Well, when you are selling these shares, there will be two things that's going to happen. One, there will be a reduction from treasury stocks, right? The original cost of these shares will be reduced from treasury stock. And if you look at the note, after we'll sell this treasury stock back to the market, what is the increase in treasury stock, or what is the reduction in treasury stock? What positive numbers we are adding? That's going to be 991. So basically, original cost of these items when we were acquiring was 991 million. Okay, and then the question here is, did we make money or lose money out of these treasury stock transactions? Well, again, if you look at the statement of stockholders' equity, look at the first item here. It says treasury stock transactions. And what is the impact of these treasury stock transactions? It increases common stock by 264. So what's going on? Well, if you look at this paragraph after the table, what does it say? It says that beginning and ending balances for all periods include capital in excess of par. So basically, when you see a common stock here, it's not just the common stock, just the par value of these shares. It also includes additional paid in capital. And what did we learn? When you sell shares, when you make a gain or loss, this gain and loss are included either in additional paid in capital or in retained earnings. So in this question, the additional paid in capital increased by 264. It looks like that we are making money out of reissuing these shares back to capital markets. So if you sum these two numbers, 991 is the original cost of these shares when we were acquiring them. 264 is the amount of profit that we make when we are selling them. And if you do the algebra, it looks like that we are reissuing these shares from $96.18. And here is case number 3. Using the attached excerpts for Wells Fargo Company's 2017 annual report, answer the following questions. 1. How many shares of common stock were authorized? How many shares of common stock have been issued? Authorized is about 9 billion. The amount of shares issued is 5,481,811,474. Where will I find this information? I am going to look at my balance sheet. I'm going to look at equity section. These numbers are explicitly written if you look at the line called common stock. Authorized number of shares and issued number of shares are explicitly given. Question number B. Wells Fargo also has repurchased some of its own shares of stock that had been previously issued. So we are talking about treasury stock here. How many shares did Wells Fargo hold as treasury stock at the end of year 2017? That number is 590,194,846. Where did I get this number? I get this number again from a shareholders equity section of the balance sheet. There is this line item called treasury stock. This number is explicitly given over there. Next question is, how many total shares were outstanding at fiscal year end 2017? This is a simple algebra. You take the number of issued shares, which is about 5.5 billion, minus the number of shares in our treasury stock, which is 590 million. And you can see those numbers in the shareholders equity section. If you just take their difference, you're going to find that about 4.9 billion shares are outstanding. Next question is asking us, what is the par value of each share of common stock issued? It's going to be 1.67. Where will I find this information? Again, I'm going to look at shareholders equity, look at the common stock row. This number is explicitly given as 1.67. How much money in excess of par value of stock had been contributed by shareholders by the end of year 2017? That number is 60,893 million. Where will I find this number? Again, I'm going to look at shareholders equity section. The third line item here is called additional paid in capital, and that number is explicitly given here, 60,893. How much did Wells Fargo pay for treasury stock it held at the end of year 2017? That number is 29,892. Where will I find this number? Again, I'm going to look at shareholders equity, look at the treasury line item called treasury stock, and its value at the end of year 2017 is 29,892. Now I will deal with some transactions associated with shareholders equity. First one is record a declaration and payment of dividends in year 2017. Let me start with preferred shares and their dividends. So I'm saying that the amount of preferred share dividends declaration is how much? It's 1,629. If you declare this much of dividends, what's going to happen? Retained earnings will go down and it's going to be recorded as dividend payable. When you pay this money, 1,629, dividend payable will be removed and then the cash will be decreased. So let's just confirm that the amount of dividend payments associated with preferred share is 1,629. How am I going to do this? I'm going to look at this consolidated statement of changes in equity. I'm going to focus on preferred stock dividends. So if you look at the second item in this rectangle, you are going to see that the reduction from retained earnings associated with preferred stock dividends is 1,629. Does that mean that all of these dividends have been paid? Not necessarily. To check whether dividends have been paid or not, we have to look at cash flow statements, which is the next item here. Here is the financing section of the cash flow. There is a line item called here preferred stock. If you go down under preferred stock, cash dividend paid is how much, which is the first rectangle here, 1,629. Yes, so we declared and paid this much of dividends. We confirmed this. Now we are going to do the same exercise for common stocks. So what is the amount of dividend declaration for common stocks? Here it says 7,708. But does that mean that all of this number is in dividend payable? No, the dividend payable is 7,658. Why? Because there is an increase in the additional paid in capital of 50. So let's just see this. This looks quite interesting. So please focus on the first line here. There's a statement of stockholders' equity. The reduction from retained earnings associated with common stock dividends is 7,708. Okay, but notice that associated with these dividends, additional paid in capital is increasing by 50. So we don't have enough details exactly where this 50 is coming from. It's probably stock dividends. Therefore, to make the algebra correct, so retained earnings decreases 7,708. Additional paid in capital goes up by 50. It must be the case that dividend payable at the time of dividend declaration is 7,658. Does that mean that we paid all of these dividends? For this one, I'm going to look at cash flow statement. I'm going to look at cash flow statement and common stock dividends. And common stock dividends paid in this year is how much? 7,480. So if I go back, the amount of payment for dividends is 7,480. It looks like that all of the declared dividends for common stocks are not paid yet, and they will be probably paid sometime in the future. So we declared there's a dividend payable 7,658, 7,480 is paid, the rest will be paid some other time. Now we are going to look at record the purchase of treasury stock in year 2017. The amount of treasury stock is how much? 9,908. If you buy this treasury stock, you are going to record a negative number under treasury stock, and the cash will also go down by 9,908. Where is this number coming from? To see this number, you are going to look at cash flow statement. You are going to look at cash flow from financing activities, and if you look at common stock repurchases, it's going to be 9,908. And finally, we will focus on a couple of numbers under earnings per share. The first question is asking you what is the basic earnings per share number. From the income statement, that number is 4.14. From the income statement, there is a line item called earnings per share common. It's going to be $4.14. And the next part of this question is asking you what is the Wells Fargo's diluted earnings per share. That number is $4.10. Where will I find this information? Again, I'm going to look at income statement. I'm going to look at line item called diluted earnings per share. It is $4.10. Here is the fourth case. Top of the World Limited reported the following summarized balance sheet at the end of year 2010. So we have some simplified version of assets, liabilities, and common shareholders' equity. Since we are here, let's just focus on a couple of items here. Common stock value is 1,000. Par value is 1. It must be the case that the number of common stock is 1,000. Preferred stocks, they have $100 par value, but we don't have any preferred stocks yet, and we don't have any treasury stocks too. And we have 6 transactions that we are supposed to record. Okay, instead of reading them one by one, I will start recording them in the next transaction worksheet. Okay, what's the first transaction? It says issue 2,000 shares of common stock from $20 each. Therefore, cash goes up by 40,000. Common stock goes up by 2,000 because we are printing 2,000 shares. Each of these shares has a par value of 1, and it must be the case that addition paid in capital increase is 38,000. The next item is on February 1st, we are going to issue 100 shares of preferred stock from 110. Therefore, cash goes up by 11,000. Preferred stock, okay, which is where we are recording just the par value of this preferred stock, goes up by 10,000. If you just go back to the beginning question, you are going to see that par value of each of preferred share is 100. 100 times 100 is going to give you 10,000. It's not balancing. To make it balanced, there will be an additional paid in capital of preferred stock. It's going to be 1,000. The third item here is declare a cash dividend of $5 per preferred shares and $1 per common share. All right. So if you do these calculations, how many shares do we have outstanding? So far we have 100 shares. If you look at star at the end of this transaction worksheets, we have 100 shares. For each of these shares, we promise to pay $5. We have 3,000 common shares. Why it is 3,000? Well, because originally we started with 1,000 and then we printed 2,000 more. And for each of these 3,000 common shares, we are going to pay $1 dividends. If you do the algebra, you are going to find that the amount of retained earnings decrease associated with these all dividend payments, 3,500. Since you are just declaring these dividends, dividend payable will be 3,500. And the next item is telling you that you got to pay cash dividends. Dividend payable is reduced, and then 3,500 is also reduced from cash. And October 1st, we reacquired 200 shares of common stock as treasury stock, paying $25 per share. So therefore, cash will be going down by 5,000, and 5,000 will also be recorded as a negative item under treasury stock. And then we are going to sell 100 shares of these just acquired treasury stocks from $28 each. Therefore, cash goes up by 2,800. The reduction from treasury stock will be the original cost of these 100 shares. Originally, we purchased these shares $25 each. 25 times 100 is going to give you a treasury stock decrease of 2,500. And finally, it looks like that you are making a gain of 300, and this gain will be recorded under additional paid in capital. And the second part of this question is asking you, what is the shareholders' equity at the end of year 2011? It looks like that for year 2011, the amount of net income was 4,000. Common stock is 3,000, which is coming from beginning common stock of 1,000 and 2,000 new common stock issues. Preferred stock is 10,000. This is what we issued this year. Paid in capital is originally it was 14. There is an increase of 38,000. There is another increase of 1,000. There is 300 coming from profit associated with treasury stock sales. Retained earnings was originally 5,000. Due to dividend payment this year, it decreased by 2,500. And then there is another 4,000 which is coming from this year's net income. Treasury stock was originally 0. It increased by 5,000 and then it decreased by 2,500. So net it is 2,500. Treasury stock is always negative. If you sum all these numbers up, you are going to find that at the end of year 2011, the amount of shareholders' equity is 69,300. And here is case number 5. The following pages contains the consolidated statements of shareholders' equity for P&G from their 2016 annual report. Using this information, we need to answer some question. Question number 1, what is the number of common shares outstanding at the end of year 2016? To answer this question, actually we are quite lucky. We are looking at statement of shareholders' equity for this company. If you look at the first line item, it says common shares outstanding. This number is explicitly given. At the end of year 2016, this number is 2,668,074. All right, so we are very lucky. We don't need to calculate anything. This number has been explicitly given in the statement of shareholders' equity. Number 2, how many shares of common stock did P&G repurchase in fiscal year 2016? That number is 103,449. Where will I find this number? Again, I'm going to look at statement of stockholders' equity. I'm going to look at common stock outstanding column. There is a treasury purchases line here. Its value is 103,449. Notice that when we purchase these treasury stocks, what happens to common stock outstanding? It goes down. That's the reason why this number, 103,449, is in parentheses. What was the average price per share P&G paid for the shares it repurchased in fiscal year 2016? That number is $79.43. How did we find this? Well, we already know the denominator, right? How many shares we repurchased? 103.449 million. So the question is how much we paid actually for this. Is it going to be 8,217? Where is this number coming from? If you look at again the statement of stockholders' equity, look at the treasury stocks row, and then when we buy treasury stocks, what happened to treasury stock column? Okay, it decreases by 8,217. So this is the amount of money we spent when we are acquiring these treasury stocks. So if you do the algebra, you're going to find that for these shares, we paid $79.43 for each cent. Part C. How many shares did P&G reissue in fiscal year 2016? And that is going to be 56,952. It's coming from two sources. The first source is 52,089,000 for shares for employee plan issuances, plus 4,863 for preferred stock conversions. So how do we see these numbers? Again, you look at statement of stockholders' equity. You look at common stock outstanding column, and we have two items here which is increase in the common stock outstanding. What are these? Employee plan issuances and preferred stock conversions. If you sum these two numbers, you are going to find that the increase or the reissuance of shares in this year is how much? 56,952. D, what was the average price P&G received from issuing shares to employees and share owners in fiscal year 2016? So what do we know about reissuing these shares? Well, there will be a reduction from treasury stock for the cost, and there can be a gain and loss associated with this issuance. All right, let's just go through these reissuances one by one. So I'm going to look at here statement of stockholders' equity. For the first item here, employee plan issuances, what happened? We issue shares, and the treasury stock gets a positive number. How much is this? 3,234. Therefore, 3,234 is the original cost of these shares that we are giving to our employees for part of their compensation. Is there a gain and loss? Probably, because if you look at the column called addition paid in capital, there is a negative item here. How much is that negative item? 144. And what did we learn? If you make a gain or loss from these stock reissuances, you record them either under addition paid in capital or retained earnings. So you see, it looks like that from reissuing these shares to employees, we make a loss of 144. We are going to repeat the same exercise for preferred stock conversions. Due to preferred stock conversions, the increase in treasury stock is 33. So that must be the original cost of these shares. Do we have a profit or loss? And again, if you look at addition paid in capital, there is a profit of 6. So it looks like that because of these conversions, we made a profit of 6. Now, if you do the algebra, you're going to find that on average, from these reissuances, we make how much? For $54.94. And here is our case number 6. We are going to look at McDonald's financial statements for year 2013, and accordingly we are going to answer some questions. Here is question number 1. How many shares of common stocks were authorized at the end of year 2013? How many shares have been issued? The authorized number of shares is how much? 3.5 billion. Issued number of shares is 1,660.6. And they are all given in the shareholders' equity of the balance sheet for McDonald's. Part B of this question. How many shares of preferred stocks were authorized? How many shares of preferred stock have been issued? Again, I'm going to look at shareholders' equity section of the balance sheet. The authorized number of shares is 165 in millions, but it looks like that we didn't issue any preferred stocks yet. McDonald's also has repurchased some of its own shares that has been previously issued. Here we are talking about treasury stock. How many shares of did McDonald's hold as treasury stock at the end of year 2013? That number is 670.2. Where will I find this number? Again, I'm going to look at shareholders' equity. There is this line item called common stock and treasury. And the first number here is 670.2. That's the number of shares that we hold in treasury. And part D of this question is asking you how many shares are outstanding. Basically, you take the number of shares printed minus number of shares in treasury. It's going to be 990.4 in millions. So you take the number of shares printed, that's coming from the common stock row, and then you also take the common stock in treasury stock, which is 670.2. If you do the algebra, you are going to find that the amount of number of shares outstanding is 990.4 in millions. Now we have some questions about common stock. The first question is asking you what is the par value of each share of common stock. That's going to be 1 cent. It is again coming from shareholders section of the balance sheet. Common stock 1 cent is explicitly written in that rectangle. How much money in excess of the par value stock had been contributed by shareholders by the end of year 2013? That number is 5,994.1. It's coming straight from balance sheet. You look at the shareholders' equity section. Additionally paid in capital is explicitly given. How much did McDonald's pay for treasury stock it held at the end of year 2013? So what is the cost of all of these shares that we hold in the treasury stock? It's going to be 32,179. Where is this number coming from? Again, look at balance sheet, shareholders' equity. For year 2013, that number is 32,179.8. Now we will go through some transactions. First, declaration and payment of dividends. The declared and payment of dividends is how much? 3,114.6. So where is this number coming from? Well, we are going to look at consolidated statement of shareholders' equity to see how much dividends has been declared. If you look at 2013, if you look at the rectangle here, you are going to see that due to this declaration of dividends, the decrease in retained earnings is 3,114.6. Does that mean that all of these dividends has been paid? No. You need to confirm this by looking at cash flow statement. In the cash flow statement, you look at the financing section, and then there's a line item called common stock dividends. That number is 3,114.6. So it looks like that all of these dividends has been declared and paid. Another transaction question here is record the purchase of treasury stock. And it looks like that in this year we purchased 1,777.8 in treasury stock. Where did I find this number? I am going to look at again financing section of the cash flow statement. There is a line item called treasury stock purchases. That number is 1,777.8. Finally, we will deal with basic and the diluted earnings per share of McDonald's. What is the basic earnings per share? 5.59. Where is this coming from? Consolidated statement of earnings. If you look at here, there's a line item which explicitly said earnings per share basic 5.59. And then there is another question which is going to ask us diluted earnings per share. It's going to be 5.55. Where is this coming from? Again, I'm going to look at the income statement. There's a line item here called earnings per share diluted. It's going to be $5.55. This concludes my discussion of cases associated with shareholders' equity. Hello, welcome to Financial Accounting Advanced Topics here at University of Illinois. Today we are going to talk about cash flow statements. Here is a brief overview of what we are going to do today. First, we are going to compare net income to cash flows. And then we will briefly discuss what kind of information we can learn from cash flow statement. And finally, we are going to spend a lot of time on preparation of cash flow statement. So what is net income? Well, the number that you see at the end of income statement is net income. In other words, net income summarizes firm's revenues, expenses, gains, and losses. Net income is a useful proxy for profitability. However, net income doesn't tell you anything about company's liquidity position. For example, company can be very, very profitable, but it doesn't necessarily mean that company is also generating a lot of cash. If you want to learn company's liquidity position, you have to look at cash flows. And we have cash flow statement to analyze company's cash inflows and cash outflows in a systematic manner. So what kind of information we can learn from cash flow statement? First of all, by looking at cash flow statement, you can learn where cash is generated and how this cash is spent within a firm. Second, by looking at cash flow statement, you can evaluate company's operating, financing, and investing policies. Third of all, by looking at cash flow statement, you can compare net income to cash flows generated from operations so that you have an idea about company's earnings quality. And I'm going to have a discussion about this soon. And finally, cash flow statements help you to predict future cash flows much more precisely. Cash flow statements have three parts. The first and the most important part is cash flows from operations. Here we will see from the company's core operations how much cash is generated. The second component is cash flows from investing activities. Here we will see how much cash is spent or generated company's investment activities. And most of the time when I say investment, you should think about fixed assets. And finally, the third component is cash flow from financing activities. Here we will have an idea about company's cash generation or cash spending on financing activities. By financing, I'm talking about equity issues, dividends, and bank loans. Here is an example of cash flow statement for Walmart at the end of year 2015. And let's first concentrate on the last box. The first number on the last box is net increase in cash and cash equivalents of 1,854. This is the amount of cash generation, net cash generation in year 2015. The second number is cash and cash equivalents at the beginning of the year, and that amount is 7,281. So we know beginning amount of cash, we know the amount of cash change within year 2015, and if we sum them up, we are going to find the last number on this box, which is cash and cash equivalents at the end of the year of 9,135. In other words, cash flow statement explains to you in detail how cash of Walmart changed between year 2014 and 2015. And this amount of cash change is 1,854. So the question here is, where is this cash change coming from? The first and the most important section of cash flow statement is cash flow from operations, and that is the first box in the slide. How much is the cash flow from operations for Walmart? It is 28,564. That's a huge positive number. So Walmart generates this much of cash from its core operations. This is buying and selling groceries. Secondly, we have cash flows used in investing activities of negative, because the number is in parentheses, 11,125. This is the total amount of cash used in investing activities. And thirdly, we have cash used in financing activities of, again minus, because it is again in parentheses, 15,071. So basically, cash flow from operations, cash flow from investing activities, and cash flow from financing activities will give you net cash change in year 2015 of 1,854. Now we are going to spend some more time on preparation of cash flow statement. Now we are going to spend some time on preparation of cash flow statement. Cash flow statement has three parts: cash flow from operations, cash flow from investing, and cash flow from financing activities. And if we sum these three sections, you will find the net cash change within a period. Most of the time this period is a year. So what kind of information do we need in order to prepare cash flow statement? We need at least 2 years of balance sheet so that we can calculate changes in some accounts. We need income statement, and we also need some additional information about, for example, non-cash transactions, depreciation, or dividends. The first and probably the most important section of cash flow statement is cash flow from operations. And we are going to prepare cash flow from operations by using indirect methods. This method is called indirect because we are going to start our journey with net income. We are going to do a bunch of adjustments to net income so that we can end up with cash flow from operations. The starting point is net income, which is the number at the end of income statement. And then we are going to do 4 adjustments to net income so that we end up with cash flow from operations. The first adjustment is adjusting for non-cash transactions. And the most prominent example here is depreciation. The idea here is that since you start your journey with net income has the effect of depreciation expense. But then you step back and ask yourself, is depreciation associated with cash? Not really. Depreciation is just allocation of cost of a fixed asset over a certain number of years. It has nothing to do with cash. Therefore, you first add back these non-cash charges. When you see depreciation expense, for example, you add back this depreciation expense amount to net income. That is the first adjustment. The second adjustment is to neutralize the impact of gains and losses. And most of the time, these gains and losses are generated when you're selling, for example, a fixed asset. Suppose that we are selling a fixed asset and this results in a gain. The question here is whether this gain is associated with cash flows. It is, but when you make a cash by selling fixed asset, this cash will be recorded under which section? It is cash flow from investing activities. It has nothing to do with operations. Therefore, you need to undo the effect of these gains and losses. If you have a gain, you deduct that amount. If you have a loss, you add it back. And that is the second adjustment. The third adjustment is a little bit tricky. The third adjustment is you need to adjust for operating assets increases and decreases. What do I mean by operating assets? By operating assets, I'm talking about account receivables, inventories, and prepaid expenses. And the rule is if operating assets go up within the year, you deduct. If operating assets go down, you add it back. And what exactly is the logic here? Let me give you a simple example. Suppose that we have a firm making a sales of $500. Therefore, on the income statement, this $500 will show up as a revenue. And suppose that we are making these sales, but we are not collecting the money from customers. Therefore, it is going to be recorded as accounts receivable. Now, my question here is whether this $500, which already shows up in net income, is associated with cash flows or not. The answer is no, because we didn't collect the money from customers. Instead, we recorded this amount as account receivable. So as you see, the amount of increase in account receivable here is nothing to do with cash. And therefore, when operating assets go up, we deduct them. And similarly, when operating assets go down, you add them back. And this is the third group of adjustment. The fourth group of adjustment is you also do adjustments for changes in operating liabilities. By operating liabilities, I'm talking about accounts payable, wages payable, and unearned revenue. And the rule here is this: when they go up, you add it back. When they go down, you deduct. What exactly is the logic here? Let me give you another example. Suppose that we are collecting money, $1,000, from customers for a service that is going to be delivered in next year. How am I going to do the accounting for this? Cash goes up by $1,000 and unearned revenue goes up by $1,000. So notice here that I am making a collection from customers. This is cash flow from operations, but this amount doesn't show up in income statement. Why? Because this is for a service we are going to deliver sometime in the next year. Then what is the rule here? When you have an increase in liabilities, in our case this is unearned revenue, you need to add back this amount to net income so that you come up with cash flow from operations. So the rule here is operating liabilities go up, you add them. Operating liabilities go down, you deduct them. Let's do an example about this. Here I am going to prepare cash flow statement of Illini Supermarket for year 2016. And what type of information I need to prepare this statement? First, I need at least 2 years of balance sheet. This is what I have on the screen. I need information about income statement for year 2016, and I also need additional information. What type of additional information am I given? First, the amount of depreciation expense for year 2016 is $800, and this is included as a part of operating expenses. Basically, if you look at the income statement here, there is an operating expenses row, and that number of 800 is included here. And the second piece of information I have here is the question is explicitly telling me that there is no purchase or disposal of fixed assets in year 2016. The first step to prepare cash flow from operations, in general cash flow statement, is put these 2 years of balance sheet next to each other and calculate the changes. So basically, for example, between year 2015 and 16, the amount of cash goes up by $11,006. Account receivable goes down by $9,000. Inventories go up by $2,500, so on and so forth. Second, please attract your attention to the red number on the screen, which is the amount of cash change within year 2016. And that amount was $11,006. So basically, we are going to come up with a cash flow statement such that it's going to explain me in detail why cash for Illini Supermarket changes between year 2015 and 16 by $11,006. The first section of cash flow statement is cash flow from operations. We are going to use indirect method. Therefore, we are going to start with net income. Net income for year 2016 is $3,864. Is this correct? Let's just go back to income statement. Please look at net income after taxes number, $3,864. That's correct. And what is the adjustment? We are going to do some adjustment for changes in operating assets, changes in operating liabilities, non-cash charges, and gains and losses. What is the first non-cash charges that we need to worry about? Well, the question explicitly tells me that the amount of depreciation expense for year 2016 is $800. And what is the rule? When you have a non-cash charges, you add it back. This is precisely what I am doing here. The second adjustment is the neutralized impact of gains and losses. And I said most of the time these gains and losses stem from selling assets. But the question and additional information explicitly tells me that there is no fixed asset sale or disposal. So it looks like I don't have any gains and losses. So I'm not worried about this. The third adjustment is you need to do adjustment for operating asset changes. For example, let's just go back. What type of operating assets we have? We have a decrease in account receivable of 9,000. And we also have increase in inventories of 2,500. So what was the rule? If operating assets decrease, you add it back. If operating assets increase, you deduct it. Account receivable decreased by 9,000, I add it back. Inventories increased by 2,500, I deduct this. And this is the third group of adjustment. The fourth one is you need to do also adjustments for operating liabilities. Again, I'm going to go back. What type of operating liabilities I have here? Accounts payable doesn't change, so I don't need to worry about it, although it's an operating liability. Dividend payable. Is this an operating liability? Dividends. Dividends are associated with shareholders, and the investments to shareholders will be taken care of in cash flow from financing activities. So I'm not worried about this. How about tax? Tax is part of operations, therefore I need to worry about this. Tax payable goes up by 1,562. I need to take care of this. And how about interest? Interest goes up by 380. Do I need to worry about this? The answer will be yes, and I'm going to spend some more time about this soon. So let's just go back our cash flow statement. Tax payable increases by 1,562. The rule about operating liabilities is if they go up, we add it. If they go down, we deduct this. And I am also claiming you that interest is also associated with operations. Interest payable goes up by 380. Therefore, we add it back. So let me just take a small break here. Logically, interest shouldn't be operations. We are paying this interest to, for example, bank lending. And bank lending is taken care of in cash flow from financing section. This is an exception under US GAAP, US accounting rules. Under US accounting rules, as an exception, we are going to assume that interest is always operations. This is an exception. It doesn't make sense, but we need to live with this. Interest is operations. Therefore, interest payable goes up by 380, and I add this as a part of cash flow from operations. And then you sum up all of these numbers, and you find that at the end of year 2016, the amount of cash generated from operations is 13,106. Now I'm going to spend some time on cash flow from investing activities. By investing, I'm talking about, for example, fixed asset acquisitions, disposal, etc. So what type of investing activities I have on the balance sheet? It looks like there is a change in the machinery of $800. There is a decrease of $800. My question here is this a change because we are selling an asset? Probably not. We have a piece of additional information given in the question. It says there is no purchase or disposal of fixed assets in year 2016. So where is this change coming from then? This change is coming from the first piece of additional information, that is depreciation expense. Depreciation expense reduces the value of machinery by $800. There is no purchase, there is no sale of fixed assets. And therefore, the cash flow from investing activities in year 2016 is just zero. There is an 800 change. It is not about buying and selling fixed assets, just depreciation, which we have already taken care of in operating section. Now I'm going to spend time on cash flow from financing activities. By financing, I'm talking about equity issuance, bank loans, dividends. So let's see what type of transactions we have here. It looks like the amount of bank loan decreases by 3,000. So I need to consider this when I'm preparing cash flow from financing activities. It looks like common stock increases by 1,000. Again, I need to worry about this. And also look at the fact that dividend payable goes up by 100. I need to also take into consideration when I'm preparing cash flow from financing activities. Let me just go back. The first thing I'm going to take care of is equity issuance. According to the previous slide, it looks like the amount of equity issuance $1,000. It's going to be recorded as a positive cash flow from financing activities. Second, there's a bank loan repayment of $3,000. I am recording this as a negative. It is repayment. And finally, how much is the amount of dividends? If you go back to the income statement, The amount of dividends is explicitly written over there, $200. Can I assume that in year 2016, Illini Supermarket paid dividends of $200? Probably not. Why? Because of existence of dividend payable. In reality, what happened is that, let's look at the transaction here. Illini Supermarket declared a dividend payment of $200. Therefore, there is a reduction of $200 from retained earnings. Out of 200, 100 is paid with cash. Therefore, there is a cash decrease of 100. And the remaining 100 is recorded or still remaining as dividends payable. Therefore, the amount of dividends paid that you need to worry about for preparing cash flow from financing activities is just 100. And that is exactly included here. And if you sum these three numbers, you are going to find that cash flow from financing activities in year 2016 is minus 2,100. Now I'm going to put all these three sections of cash flow statement together. Cash flow from operations of 13,106, cash flow from investing activities of just 0, and cash flow from financing activities of 2,100 negative. And if you sum them up, you're going to find the net cash change in year 2016 is how much? 11,006. Remember, that's how we started our journey. Initially, we have seen that the cash change between year 2015 and 16 for Illini Supermarket was 11,006. Now, by means of this cash flow statement, I explain in detail how this cash changes by 11,006. And that is the beauty of cash flow statement. Now, let me just spend a couple of minutes on earnings quality. When we are analyzing financial statements, and if you take, for example, in the financial statement analysis course, you need to always observe a close correspondence between cash flow from operations and net income number. If there is a huge discrepancy between these two numbers, then you need to worry about earnings management. The idea here is that firms can manage their earnings. They can do a lot of accounting frauds or aggressive revenue recognition techniques. Therefore, they can increase their net income. But if this is not supported by increased also cash flows, then this is a very good indication that there is something going on. So as an analyst, as an accounting student, you need to go back and analyze why there is a discrepancy between net income and cash flow from operations. And if you cannot explain this discrepancy meaningfully, there is a good chance that firms are managing their earnings. Here is a summary of what we have done today. Today we discussed what type of information we can learn from cash flow statements. And then we spent a lot of time on preparation of cash flow statements. Thank you. In this video, I'm going to introduce you direct method of cash flow from operations preparation. Let's remember indirect method of cash flow from operations. We started our journey with net income, and we have done 4 groups of adjustments. 1, we adjusted for non-cash expenses like depreciation. We made adjustments for gains and losses like from asset sales. And then we have also done adjustments for operating assets and operating liabilities, and we come up with cash flow from operations. Indirect method of CFO shows the adjustments to net income to calculate CFO, but is not useful to show the exact cash paid or collected for each operating activity. For example, indirect method of CFO doesn't help to answer how much cash collected from customers or how much cash paid to suppliers. Direct method of cash flow from operations shows cash paid collected for each operating activity explicitly. Then of course your question is, why don't we use direct method of cash flow from operations? The purpose of cash flow from operations is to show you the correspondence between net income and cash flow from operations. So given the net income, how much is cash flow from operations? That's the purpose of CFO statement. The purpose is not to show you how much cash you collected from customers, how much cash you pay to suppliers. However, knowing the direct method of cash flow from operations can make cash flow from operations more intuitive for you. So how are we going to calculate CFO under direct methods? I'm going to worry about 6 cash payments or cash collections under cash flow from operations. These are cash collections from customers, cash collections from interest and dividend income. Just an important point here. Although interest is associated with my financing operations, we just said that interest is always operations. This is an exception. Similarly, dividend income. Dividend income is also coming from my investing activities. However, when you get dividend income, it is stuck in net income. Therefore, dividend income is also part of operations. Third, we are going to worry about cash paid to suppliers, cash paid for operations, cash paid for tax purposes, and cash paid for interest. So here is our example that we have used to calculate cash flow statement in the previous video. It is exactly the same numbers. I have balance sheet numbers for year 2015 and 16. I also have income statement number for 2016, and then we are given some extra information that the amount of depreciation expense is $800 and is recorded under operating expenses, and there is no purchase or disposal of fixed assets in year 2016. Now, let's start to calculate cash flow from operations using the direct method. The first thing that we need to calculate is cash collections from customers. To do so, we are going to keep track of how account receivables change over time. There is a beginning amount of account receivables. Account receivables will go up with sales, plus sales. Account receivables will go down by cash collections from customers, which is what I am after. And at the end, you're going to end up with ending amount of account receivables. By using the balance sheet and income statement that you have just seen, I'm going to now fill these numbers. Beginning amount of receivables is $11,000. The amount of sales is $24,000. The amount of ending account receivables is $2,000. And therefore, cash collections from customers, which is equal to sales minus change in account receivables, it's going to be $33,000. One important note here, in the presence of unearned revenue, cash collections from customers need an additional adjustment. So let's see what this adjustment looks like. How does unearned revenue account change? There is beginning unearned revenue. Unearned revenue will go up by cash advances from customers. Notice that it is cash coming from customers. Minus unearned revenue will go down, service delivered to customers, and we are going to end up with the ending amount of unearned revenue. In other words, cash advances from customers, which is another component of cash collections from customers, is equal to services delivered plus change in unearned revenue. So cash advances from customers is equal to service delivered plus change in unearned revenue. If you look carefully at this formula, service delivered has already been included in sales. Therefore, in the presence of unearned revenue, cash collections from customers will need the additional adjustment of plus change in unearned revenue. So, cash collections from customers is equal to sales minus change in account receivables plus change in unearned revenue, which we have been just introduced in this slide. Coming back to our original question, there is no unearned revenue. Therefore, cash collections from customers is, as we have calculated, $33,000. The second component here is cash collections from interest and dividend income. So where am I going to find these numbers? Is there any cash collections for interest income or dividend income? I'm going to look at balance sheet to see whether there is any interest receivable or dividend receivable. I don't see them. I'm going to look at my income statement to see whether there is any interest revenues or dividend revenues. I also don't see them. There is a dividend payment of $200, but I don't see a dividend received. We don't have any interest or dividend receivable on the balance sheet. We have given no extra information that Illini Supermarket receives interest or dividend income. Therefore, Illini Supermarket has no interest or dividend income in this year. In real company financial statements, one needs to look at financial statement footnotes for whether a firm has interest or dividend income. So, cash collections from interest and dividend income is zero. The third component here is cash paid to suppliers. How are we going to calculate cash paid to suppliers? We are going to go through two accounts. Let me start with the right one. Change in accounts payable. How does accounts payable change? There is beginning amount of accounts payable. Accounts payable will go up with purchases of inventory. Accounts payable will go down with cash paid to suppliers, which is what I am after. And you are going to come up with the ending amount of accounts payable. So where am I going to find the purchases which I need to come up with cash paid to suppliers? You are going to find the purchases of inventory by using changes in inventory. How does inventory change over time? There is beginning amount of inventory. Inventory will go up with the purchase of inventory. Inventory will go down with cost of goods sold. And then you are going to come up with ending inventory. I am going to now put these two frameworks together, and I can calculate cash paid to suppliers is equal to cost of goods sold plus change in inventory minus change in accounts payable. Please stop the video here. Please make sure that if you follow the framework which are introduced you here, you are going to calculate purchase by using changes in inventory. And then you are going to calculate cash paid to suppliers by keeping track of how accounts payable account change. Make sure that cash paid to suppliers is equal to cost of goods sold plus change in inventory minus change in accounts payable. By using the numbers of Illini Supermarket from year 2016 and 15, I can calculate cash paid to suppliers as $10,500, which I am going to record in direct method of cash flow from operations. The next component here is cash paid for operations. So what exactly I mean by cash paid for operations? I'm going to look at balance sheet. I'm going to see whether I have any payable associated with my operations. Is there anything that catches my attention that needs to be payable? Is there anything here? I have operating expenses of $9,600. And what is cash paid for operations? Cash paid for operations includes cash paid for wages, marketing, sales, and other administrative purposes. So basically, you need to look at the balance sheet to see whether there is any wage payable, advertising payable, or other like the secretary salary payable, things like this. We do not have any payable on the balance sheet associated with these expenses. But we have an operating expense of $9,600, of which $800 is depreciation expense. Therefore, cash paid for operations is $9,600, which is my operating expenses, minus depreciation, which is not an operating expense. It doesn't require any cash. So the amount of cash paid for operations for wages, marketing, sales, and other administrative purposes is $8,800, which I'm going to record on my direct method of CFO. The next item here is cash paid for tax purposes. I'm going to again look at my balance sheet. Is there any tax payable? Yes. At the end of year 2016, there is a tax payable of $1,562. If I look at income statement, I see a tax expense of how much? $1,736. How am I going to calculate the amount of money paid for tax purposes? I am going to keep track of how tax payable changes. There is beginning amount of tax payable. Tax payable will go up with tax expense. Tax payable will go down by cash paid for tax purposes, which is what I am after. And finally, you come up with the ending amount of tax payable. By using the numbers of Illini Supermarket from year 2015 and 16, I'm going to fill this framework. Beginning amount of tax payable is 0. Ending amount of tax payable is $1,562. The amount of tax expense in the income statement is $1,736. And if you do the algebra, cash paid for tax is equal to tax expense minus change in tax payable, and you are going to find $174, which is paid for tax purposes. The last component of direct method of CFO is cash paid for interest. I am going to look at balance sheet. Do I see anything about interest? Yes, there is an interest payable of $380 in 2016. And if you look at the income statement, there is an interest expense of $800. So how can I calculate the amount of money paid for interest purposes? I'm going to keep the track of how interest payable account changes. There is a beginning amount of interest payable. Interest payable will go up with interest expense. Interest payable will go down by cash paid for interest, which is what I'm after. And finally, you come up with ending amount of interest payable. Now let's use the numbers from year 2015 and 16 for Illini Supermarket. Beginning interest payable is 0. Interest expense is $800. ending amount of interest payable is 380. Therefore, cash paid for interest is interest expense minus change in interest payable. It's going to be $420. And here I fill all the numbers which are required to calculate direct method cash flow from operations. If you sum them up, you are going to find that cash flow from operations using the direct method is 13,106. Is this number familiar to you? It is exactly the same number that we have calculated using indirect methods. Direct and indirect methods to prepare cash flow from operations result in the same amount of cash flow from operations. There is no difference. These methods do not affect preparation of cash flow from investing and financing activities. So basically, for investing and financing activities, whatever we have done for the indirect method will be the same for direct method. Now we will go to the cases about cash flow statement to see how cash flow concepts that we have just covered can be applied in real life scenarios. Here is the first case. The cash flow statement for Mattel for the year ended December 2008 is at the end of this question. Using only the information on this statement, please answer the following questions. 1. During the year ended 2008, how much did Mattel receive in cash due to sales of property and equipment? That number is 7,199. Where is this coming from? We are going to look at cash flow from investing activities. There is a line item here called proceeds from the sale of other property, plant, and equipment. That number is explicitly given as 7,199. Here is the second question. During the year ended December 2008, Mattel increased their short-term borrowings and long-term debt. How much did it receive in cash due to these two financing sources, and what were the primary three uses of these funds? All right, so received in cash for these two liabilities is how much? 980,593. Where will I find these numbers? I'm going to find these numbers from financing activities. If you look at the financing activities, the first rectangle here is proceeds from the short-term borrowings of about 633,000. The next item here is proceeds from the long-term debt. It's going to be about 347,000. And second part of this question is asking us, where did we use this money? Well, this is a loose question. All right, there is not one correct answer. All you have to look at cash flow statements and tell me why, some large cash uses, some large negative cash flow items. If you do that, let's just go through them one by one. What do we have? Purchase of other plant, property, and equipment of about 114,000. We have payments of short-term borrowings of about 976,000. We have also about payment of dividends of common stock of about 268,000. Just to make sure that we are on the same page, this is not a very precise question. All you need to do is look at the cash flow statement and tell me some large negative items. That's all. During the year ended December 2008, Mattel sold some other property, plant, and equipment. Assuming that the original cost of this property and equipment was 17,000, what was the accumulated depreciation on this other property and equipment? All right, so I'm going to use this identity. Proceeds from the loss of this equipment is equal to book value. So proceeds is how much when we sell this asset? How much did we get? Well, let's just first look at the net loss. If you look at the cash flow from operating section associated with this asset, the net loss is 6,831. If you now move to investing section, if you look at this item, proceeds from the sales of other property and equipment, 7,199. So if you sum these two items, proceeds and loss, it looks like that the book value of this item that has been sold is how much? 14,030. And what is the question is asking us? Accumulated depreciation on this asset. Well, we know the book value. We know the original cost of this plant, property, and equipment, which is given in the question as 17,000. All right, the original cost minus the net book value must be the accumulated depreciation at the time of sale of this asset, which is going to be 2,950. 70. Because accumulated depreciation is equal to cost, original cost of this item minus book value, or book value is equal to the difference between cost and accumulated depreciation. And here is the fourth question. How should Meta report a gain from the sale of used equipment for cash in the statement of cash flows using the indirect method? The gain on sale of equipment should be subtracted from net income to arrive at cash flow from operations. If there is a gain, we deduct it from net income to calculate cash flow from operations, and the entire cash inflow will be reported in the cash flow from investing activities. Here is case number 2. Use the financial statements provided. Please answer the following questions. Question number 1. During the year ended 2016, our company, Anheuser-Busch InBev operations generate a positive cash flow. How much did Anheuser-Busch, this company, receive in cash due to their operations? So there are two answers here. It's going to be either 16,044 or 10,110. All right? So where do I find these numbers? If you look at cash flow, operating cash flow sections, we have two line items here. It's either called cash generated from operations, 16,044, or net cash flows from operating activities is going to be 10,110. What is the difference between these two items? Interest paid and dividends received. As we have discussed in cash flow statements, these two items, interest and dividends, they are not necessarily operations, right? They belong to financing and other activities, general financing and investment activities. But somehow we just categorize them under operations. So what this company is doing is that, look, if you believe that these are operations, the net cash flow from operations is 10,110. If you don't believe that these are operating items, our cash generating from operations is 16,044. Therefore, both of these answers are correct. This company is separating them out because there is a lot of question mark on whether these items are really operations or not. So you can use any of these items. And second part of this question is not here. Here is the second part of this question. What is the effect of share of results of associated companies on the net cash flow from operating activities? Okay. When you read this question, you have no clue what I'm talking about, which is exactly what my point is. All right. So there is no need to panic. All you need to do is just look at cash flow statement or income statement where there is anything like this. What is this? Share of results of associated companies. All right. What I'm going to do is, first of all, I'm going to look at cash flow statement. Actually, in the operating section, there is this line item called share of results of associates and joint ventures. How much it is? Minus 16. All right. It looks like that when I'm calculating cash flow from operations, I deduct 16 associated with this item. I don't know what it is, but I deduct. All right. I'm going to continue my journey. I'm going to look at now the income statement. If you look at the income statement, there is again the same line item, share of results of associated and joint ventures, which is positive 16. So what's going on? In the income statement, because of this item, there is a positive 16. But when I'm preparing cash flow from operations, this positive 16 is removed. Therefore, the net effect of this item is what? 0. All right? So the point I'm trying to make is that you don't have to understand what this is about. By the way, if you're interested in share of results of associated companies, is basically we invest in some other companies. All right? We control them or we significantly influence them. Whenever they report the revenue, we report it. Whenever they report the loss, we report it. That's what it is. And is this a part of our operations? No, this is part of our investment activities. Therefore, it's not included here. So the answer is no effect, but the general lecture here is that there is no need to panic if you don't understand some of the line items. All right? So we have looked at cash flow statement, that is minus 16. We have looked at income statement, it's positive 16. So we start our journey with the income statement. This positive 16 has been removed when we are preparing cash flow from operations. The third question here is, for the year ended December 2016, how much income tax expense did this company show on their income statement, and how much tax they paid according to their cash flow statement? So according to the income statement, the amount of interest expense is 1,613. And then according to their cash flow statement, which you see in front of your screen, the amount of tax payment is how much? Income tax paid explicitly is written as 3,256. And here is the income statement. You can see the amount of tax expense. It is gonna be 1,613. The question number 4 is asking you, how much cash did this firm collect from its customers in fiscal year 2016? Assume that this company's revenues present a net of bad debt expense. So we are going to use two identities here. If revenues are net of bad debt expense, what you can do is that first, let's just remember what is net account receivable, which is gross account receivable minus allowance for doubtful accounts. What is net sales? Sales minus bad debt expense, which is what this question is telling me. All right, so revenues are net of bad debt expenses. If this is the case, you can use the following formula to calculate cash collections from customers. Beginning net account receivable plus net sales minus cash collections from customers is equal to ending amount of net receivables. This formula is same as the second formula in this parenthesis here. Beginning gross receivables plus sales, not net sales, plus sales, minus cash collections from customers, minus write-offs of receivables is equal to ending amount of gross account receivables. These formulas are equivalent. I strongly recommend you stop here, right? Just use the identities from the previous page. For net receivables, use gross receivables minus allowance. For net sales, use sales minus bad debt expense. And then please stop the video here. Confirm that the first and the second formula are the same. Depending on what is given, you can use either of them to calculate cash collections from customers. If you are given net amounts, you use the first formula. If you are given the gross amounts, you use the second formula. So basically, what am I going to do? I'm going to use the net amount of receivables, net amount of sales, and then hopefully I will calculate cash collections from customers. So what do I need? I need net amount of beginning and ending amount of receivables. I also need net amount of sales. Where will the net amount of sales information come from? It's come from income statement. And where will the net amount of receivables come from? It's going to come from my balance sheet. So if you look at my balance sheet for year 2015 and 16, I have some short-term receivables. I also have some long-term receivables. For example, for year 2016, short-term receivables is 874. Long-term receivable is 6,391, which constitutes my ending balances of receivables. And I know basically beginning and ending net receivables. I know the net amount of revenues. Therefore, cash collections from customers can be easily calculated as 43,616. So let's just see these numbers one more time. Net sales is coming from income statement. Net receivables are coming from balance sheet. The trick here is that we have both short-term and long-term receivables. For the year ended 2016, what was the contribution of proceeds from borrowings to this company's cash flows? That number is, how much? 86,292. Where is this coming from? It's coming from statement of cash flows. Financing activities, there's a line item explicit says proceeds from borrowings of 86,292. How much cash did this company pay to its vendors in year 2016? To answer this question, I am going to use the changes in two accounts. What are these? Change in inventory is equal to purchases minus cost of goods sold. Change in accounts payable is equal to purchases minus cash payments to vendors. If you put these two formulas together, you can come up with a formula for cash payments to suppliers, which is equal to cost of goods sold plus change in inventory minus change in accounts payable. How much is the cost of goods sold? It is, according to the income statement, second line item here, 17,803. I need information about change in inventory and change in accounts payable. Where will I get this number? You can get it from balance sheet, but I'm going to get it from statement of cash flows. If you look at statement of cash flows, there is this item called decrease or increase in inventories. The number is negative 364. It must be the case that Inventories is going up by 364. How about trade and other payables? There is a positive number of 1,251. It must be the case that trade payables are going up by 1,251. So if you put everything together, cost of goods sold is 17,803. Inventory is going up by 364. And accounts payable is going up by 1,251. You're going to find that cash payments to suppliers how much? 16,916. There's a very important note here. Note that the changes used in this computation are those due to operations. That's the reason why I got these numbers from statement of operations. What I'm telling you is that if you calculate the changes of inventory and accounts payable from balance sheet, you are not going to find the same changes. Okay? Changes in inventory, for example, on the balance sheet will not be, most of the time, 364. Why? Because balance sheet numbers can change, all right, for many reasons. For example, inventory write-down. Okay? On the other hand, the numbers that I get from the statement of cash flows, because I'm getting these numbers from operating section, are just changes in inventories due to operations. One more time. 364 is the changes in operating just because of true operating reasons. On the other hand, if you calculate these changes in operating from a balance sheet perspective, you will definitely, I shouldn't say definitely, but most of them you are not going to find the same number. Why? Because the balance sheet numbers changes not because of operations, but also for non-operating reasons such as write-downs, right? You can use both of them. You can take changes in inventory or changes of these accounts from balance sheet or statement of cash flows. But if you want the core numbers changing just operations, you need to look at statement of cash flows. If you want all changes in the inventories, you need to take these numbers from balance sheet. Here is our third case. Refer to 2014 annual report of BASF Group. To answer this question, we need statement of income, balance sheet, statement of cash flows, and we are supposed to answer the following questions. 1. Estimate the cash collected from customers. Assume that the revenue is presented net of bad debt expense. If this is the case, we just use how net account receivable changes. Beginning net account receivable is equal plus net sales minus cash collections from customers is going to give you ending receivables. All right, so what is the amount of net sales? I'm going to find this number from the income statement. That number is 74,326. What is the beginning and ending amount of account receivables? I am going to find these numbers from a balance sheet. The beginning number of receivables is 10,232. The ending amount of receivables is 10,385. I am going to use these numbers and I'm going to find that the amount of cash collections from customers is 74,174. Question number 2 is asking you, estimate cash paid to suppliers. Assume that all accounts payable relate to suppliers. We have seen this formula, right? Cash payments to suppliers is equal to cost of goods sold plus change in inventory minus change in accounts payable. How much is the cost of goods sold? I'm going to look at the income statement, and that number is going to be 55,839. Where will I find change in inventory and change in accounts payable? If you are given a cash flow statement, you can find it from there, or you can find it from balance sheet. So I'm going to find these numbers for this question from the balance sheet. Inventory beginning amount is 10,160. Inventory ending amount is 11,266. Accounts payable beginning number is 5,153. Accounts payable ending number is 4,861. If you put everything together, you are going to find that cash payments to suppliers is how much? 57,237. Assume that the company measures bad debt expense as 2% of beginning gross receivables. Further assume that the allowance for doubtful accounts balance was 337 this year and 226 last year. Calculate the amount of bad debts written off. To calculate this question, we are going to go through how allowance for doubtful accounts changes. There is a beginning balance which is given explicitly in the question as 326. The ending balance is 337. That is also given in the question. Allowance for doubtful accounts will go up when we have new bad debt expense. And what does the question tell us about bad debt expense? It is 2% of beginning gross receivables. What is the amount of beginning gross receivables? Well, beginning net receivables is 10,233. Beginning amount of allowance is 326. That is given in the question. If you sum them up, you are going to find the beginning gross receivables. Times 2% is going to give you bad debt expense of how much? $211.18. And when does allowance for doubtful accounts go down? When you have a write-offs, which is what the question is asking. If you do the algebra, you're going to find the write-offs is 200.18. How much did the company pay in total cash dividends during fiscal year 2014? It's going to be 2,766. Where is this coming from? 2,482 our shareholders and 286 to our minority shareholders. Where are these numbers coming from? It's coming from cash flow statement. We are going to look at the financing section, and here we can explicitly see how much cash we pay to shareholders and our minority investors. Here is question number 4. The cash flow statement of Smucker Company for the year ended 2018 is at the end of this question. Use only this statement and answer the following question. Question number 1. During the year ended 2018, how much did this company receive in cash due to sales of property and equipment? That number is 13.4. Where is this coming from? I'm going to look at investing section of cash flow statement. There's a line item called proceeds from disposal of property, plant, and equipment. That number is 13.4. Question number 2. During the year ended April 2018, Smucker Company increased long-term debt. How much did it receive in cash due to this financing source? And what are the primary 3 uses of these funds? Well, because of increase in long-term debt, this company generated $799.6 million. Where is this number coming from? I'm looking at the financing section of the cash flow statement. There is a line item called proceeds from long-term debt, 799.6. And the next part of this question is, where did we spend this money? All you have to look at the cash flow statement. Just tell me some large negative items. These are additions to plant, property, and equipment of 321.9, repayments of long-term debt of 1,050.3, and quarterly dividends payments of 350.3. During the year ended April 2018, Smucker Company sold some property and equipment. Assuming that the original cost of this property and equipment was 20.7, what was the accumulated depreciation on this property and equipment? We assume that loss on disposal of assets net is related to property and equipment sold. Well, first of all, I'm going to calculate the book value of this equipment at the time of sales, which is going to be the summation of proceeds and loss. All right, so where are these numbers coming from? If I look at the investing section of the cash flow statement, proceeds from the sale of this property equipment is 13.4. Is there any gain and loss associated with this transaction? Yep. I'm going to look at operating section of the cash flows. There is the line item called loss on the disposals of assets, which is going to be 6.6. If you sum these two numbers, you're going to find the net book value at the time that we are selling this asset was 20. Okay, so what is the accumulated depreciation? It's the difference between original cost and book value at the time of the sale. Original cost is given in the question as 20.7. Book value is just we have calculated 20. Their difference is going to be 0.7 million. Question number 4. How should the Smucker Company report the gain from the sale of used equipment for cash in the statement of cash flows using the indirect method? The gain on the sale of equipment should be subtracted from net income to arrive at cash flow from operations. The entire cash inflow will be reported in the cash flow from investing activities. Here is case number 5. Using the financial statements of footnotes provided, please answer the following questions. Question number 1. During the year ended 2009, the Lego Group's operations generated positive cash flows. How much did Lego Group receive in cash due to their operations? And what were the sum of the uses of these funds? Well, let's just look at cash flow from operations. And there is a line item called here net cash generated by operating activities. That number is 2,655. Where did we use this money? We used this money in income taxes, dividends, and purchase of property and equipment. So let's just see them. Where did we use this money? Income tax payments, purchase of plant property and equipment, and dividend payments to shareholders. As I said, this is a loose question. You just look at income cash flow statement and tell me large 3 negative items. All right, here is my favorite question again. What is the effect of financial expenses on the net cash flow from operating activities? The answer is none. So how did we confirm this? Let's just look at, first of all, income statement. If you look at the income statement, financial expenses line item is minus 146. Now I'm going to look at the notes to financial statements. This is note 27. It says other reversals with no effect on cash flows. And what do you see here? There's the positive financial expenses adjustment of 146. So basically what it says here is that, look, in the income statement, due to financial expenses, we have minus 46. That's like a loss. But when we are calculating cash flow from operations, we do an adjustment for this item. We add back 146. Therefore, net, the impact of these financial expenses on operating activities is 0. Here is the question number 3. For the year ended 2009, how much income tax expense did Lego Group show on their income statement, and how much tax they paid? Well, according to their income statement, income tax expense is 683, and according to their statement of cash flows, income tax payment is 619. So here is their income statement. You can see that income tax expense is 683, and here is their operating section of the cash flow statement. You are going to see that income tax payment is 619. How much cash did Lego Group collect from customers in fiscal year 2009? Assume that revenue is net of bad debt expense. We have discussed this formula, right? If everything is net, you can use the first formula here. Beginning net receivables plus net sales minus cash collections from customers is equal to ending amount of net receivables. All right, so beginning amount of net receivables is 1,822. Ending amount of net receivables is 2,128. And net sales is 11,661. So where is net sales is coming from? It's coming from our income statement, 11,661. Where are the net receivables numbers are coming from? It's coming from our balance sheet. All right. So under current assets, here they have trade receivables. Beginning is 1,822. Ending receivables is 2,128. If you put all of them in the formula, you're going to find that cash collections from customers is 11,355. The next question is also familiar. How much cash we pay to suppliers? That formula was cost of goods sold plus change in inventory plus change in accounts payable. Cost of goods sold is 3,463, which is coming from income statements. So we need information about what happened to inventories and trade payables. So inventories, we have 186, and for trade payables, we have 653. And if you put them in the formula, all right, so 3,463, inventories go up by 186. Why? Because this is not that. Please note that this is most of cash flow statements. In the cash flow statement, inventories go up. It is going to be recorded as a negative item. On the other hand, if the liabilities go up, it's going to be recorded as a positive item, 653. So both inventories and payables go up. And if you do the algebra, you're going to find that cash payment to suppliers is 2,996. And here is the last case, question number 6. We are going to refer to annual report of Campbell Soup for year 2013. And accordingly, we are going to answer the following 5 questions. Question number 1. Estimate cash collected from customers. Assume that revenue is net of bad debt expense. You now know this formula. Beginning net receivables plus net sales minus cash collections from customers is equal to ending amount of net receivables. All right. So how much is the net sales? It's going to come from income statement. Net sales is 8,052. We need net amount of receivables, beginning and ending. Beginning net receivables is 553. Ending net receivables is 635. I am using balance sheet numbers. If the statement of cash flows is available, or if you want, you can also use statement of cash flow numbers for changes in receivables. And if you do the algebra, you're going to find that cash collections from customers is 7,970. Here is second question. Estimate cash paid to suppliers. Assume that all accounts payable relate to suppliers. The formula is by now known. It is equal to cost of goods sold plus change in inventory minus change in accounts payable. Cost of goods sold number is going to come from income statement. It's going to be 5,140. Inventories number will come from the asset side of the balance sheet. Beginning amount of inventories is 714. Ending amount of inventories is 925. And accounts payable will again come from the liabilities side of the balance sheet. Beginning amount of payables is 575. Ending amount of trade payables is 523. And if you put all of them into our formula, you're going to find that the cash payments to suppliers is 5,399. Assume that the company measures bad debt expense as 2% of beginning gross receivables. Further, assume that the allowance for doubtful account balance was 11 in 2013 and 10 in year 2012. Calculate the amount of bad debts written off. To tackle this question, we need to go through how allowance for doubtful accounts change. The beginning amount of allowance is given us as 10. Ending amount of allowance is given us as 11. We don't know the write-offs. So to tackle this question, all we need is bad debts. How much is the bad debts? Well, it's going to be 2% of beginning receivables, beginning gross receivables. All right, beginning net receivables is how much? It's going to be 553. I am going to add 10 to this one, and then times 2% is going to give you bad debt expense for year 2013. It's going to be 1126. And if you do the algebra, you're going to see that the write-offs of receivables is 10.26 million. What is the effect of restructuring charges on cash flow from operating activities? The answer is again no. How do I know that? Well, I'm going to first look at income statement. There is a line item here called restructuring charges. This is an expense. It's going to be 51 millions. All right. So then I'm going to look at cash flow statement. In the cash flow statement, when operating section has been prepared, what happened? Restructuring charges of 51 million has been added back. Therefore, the net impact on cash flow from operations is 0. Okay. And here is the fifth question. How much did company pay to repurchase shares during fiscal year 2013? The answer is 153. Where is this coming from? I looked at cash flow from financing activities. There is a line item here called treasury stock purchases. That number is 153. This concludes my discussion of the cases associated with cash flow statement.
At Geese College of Business, one of our strategic priorities is to democratize education. We do that by delivering our IMBA, IMSA, Executive Education, and Business Minor online. That is not business as usual, and it's certainly not the online education of old. We put our very best faculty in the online space. They actively engage with students from around the world, face-to-face in a digital classroom. Faculty and students collaborating together infuse these programs with the personal attention that enables students to reach their full potential.
The IMBA program through the Geese College of Business is so incredibly innovative. The ability and accessibility to reach a whole new audience of students and let them learn on their own time has been phenomenal. And being able to collaborate with people across the globe and to learn from top-notch professors has been completely revolutionary.
When you're interacting and teaching in a live session, you can kind of see the student's environment. And while I'm teaching here at night in Champaign, it's daytime wherever they are in the world, some of them. And so it sort of slaps you in the face immediately that there's a completely different perspective.
You might think, oh, it's more removed, it's more distant. But in fact, my experience in an online class has actually been surprisingly intimate and connected. In a classroom setting, you might have 50, 60 or more students in a room at one time, and so I'm scanning around looking at people. But in an online, I'm looking at one place and the student's looking right back at me. And that's surprisingly a direct experience.
I was shocked at how much it felt as good or better than when I was sitting in class in my undergraduate days. Everyone has their cameras on their computers. There's a chat feature, so you can also type in a question and the professor can answer your question that way.
I think the cool thing is that you can truly participate from wherever you are. These systems work on your desktop, on your cell phone.
We were traveling in the middle of nowhere back from Indiana, and on the Wi-Fi still on my iPad, I was able to connect through Zoom with classmates in Dubai and Tokyo and California all at the same time. Even being in a remote place, on the go, the accessibility and the exposure that I was able to get was phenomenal.
Getting my MBA makes me feel empowered because I don't need to stop being myself. I don't need to stop working. I don't need to stop being a mother. I don't need to stop having my life. And that is everything.
Our online programs are designed to be career-curated learning experiences. Our leading-edge course material is structured the way that professionals apply these concepts every day. Leadership, communication, and critical thinking skills are built into the core, empowering our students to put their purpose into practice at the highest level.
One of the most impactful things is just your ability to take the skills that we deliver and take them back to work on Monday. I've heard a couple of stories where students have talked about the skills that they were able to build over a couple of weeks, and then they were able to immediately bring that skill set back into their job and make an immediate impact.
I would recommend Geese IMBA program for anyone. This is both if you're starting questioning your career, to if you're a professional and you want to hone your skill, this is it. This is the place to be.
At Geese College of Business, we are truly revolutionizing how online education is delivered. This isn't just a few PowerPoint slides and a reading assignment. Our faculty and students thrive in this one-of-a-kind global classroom. Relevant, timely discussions about current topics from around the world keep content fresh and exciting. The next generation of business leaders will come from all corners of the world, and now they converge here at Geese Business.